So if you're looking to sharpen your pattern recognition skills and make better trading decisions, stick around. This audiobook will be a game changer. Hit that like button, subscribe, and let's jump right in.
Chart Patterns, 3rd edition by Thomas Bulkowski. Introduction. Jim is struggling. He is the owner of JCB Superstores, and his competitor across town is beating him up. There is blood all over Jim's ledger. He decides it is time to take off the gloves. JCB goes public. He uses the money from the initial public offering to buy his competitor and add a few more stores around town. With a growing sales base, Jim's clout allows him to negotiate lower prices for the office supplies he sells. He passes on part of the savings to his customers, while watching his margins widen, and plows the profits back into building more stores and updating existing ones. Jim calls his friend Tom and tells him of his plans to expand the operation statewide. They chat for a while and exchange business tactics on how best to manage the expansion. When Tom gets off the phone, he decides to conduct his own research on JCB. He visits several stores and sees the same thing: packed parking lots, people pushing full shopping carts, and lines at the checkout counters. He questions a few customers to get a sense of the demographics. At a few stores, he even chats with suppliers as they unload their wares. Back at the office, he does a thorough analysis of the financials and looks at the competition. Everything checks out, so he orders his trading partners to buy the stock at no higher than $10 a share. When news of the expansion plan hits the wires, the street panics. It is, after all, a soft economy, and expanding willy-nilly when a recession looms is daft, maybe even criminal, according to some news outlets. The stock drops below 10, and Tom's crew makes its move. They buy as much as they can without raising suspicion. The stock rises anyway. It goes back up to 11, then 12, and rounds over at 13 before heading back down. Several months go by, and the economic outlook is as bleak as ever. The stock eases down below 10. After Tom checks in with Jim for the latest public news, Tom's team buys more. It is an easy score because investors are willing to dump the stock, especially as year-end tax selling approaches. 6 weeks later, the company releases the sales numbers for JCB. They are better than expected. The stock rises 15% in minutes and closes at $10.75. And that is just for starters. 6 months later, it's clear the economy was never in danger of entering a recession, and everyone sees boom times ahead. The stock hits 20. Years go by, the stock splits a few times, and the holiday season looms. Tom interviews a handful of customers leaving JCB Superstores and discovers that they are all complaining about the same thing. The advertised goods are not on the shelves. Tom investigates further and discovers a massive distribution problem right at the height of the selling season. JCB has overextended itself. The infrastructure is simply not there to support the addition of one new store each week. Tom realizes it is time to sell. He tells his trading department to dump the stock immediately, but for no less than $28.25. They liquidate about a third of their holdings before driving the stock down below the minimum. Since it is the holidays, everyone seems to be in a buying mood. Novice investors jump in at what they consider a bargain price. The major brokerage houses climb aboard and tout the stock, but Tom knows better. When the stock recovers to its old high, his trading partners sell the remainder of their holdings. The stock tops out and rounds over. During the next month and a half, the stock drifts down, slowly, casually. There is no rush for the exits, just a slow trickle as the smart money quietly folds up shop and moves on. Then news of poor holiday sales leaks out. There is a rumor about distribution problems, merchandising mistakes, and cash flow problems. Brokerage firms that only weeks before were touting the stock now advise their clients to sell. The stock plummets 39% overnight. One or two analysts say the stock is oversold. It is a bargain, and investors should add to their positions. Many bottom fishers follow their broker's advice and buy the stock. Big mistake. The buying enthusiasm pushes the price up briefly before a new round of selling takes hold. Each day the stock drops a bit lower, nibbling away like waves washing against a castle of sand. In 2 months' time, the stock is down another 30%. The following quarter, JCB Superstores announces that earnings will likely come in well below consensus estimates. The stock drops another 15%. The company is trying to correct the distribution problem, but it is not something easily fixed. It decides to stop expanding and to concentrate on the profitability of its existing store base. 2 years later, Tom pulls up the stock chart. The dog has been flat for so long, it looks as if its heartbeat has stopped. He calls Jim and chats about the outlook for JCB Superstores. Jim gushes enthusiastically about a new retailing concept called the Internet. He is excited about the opportunity to sell office supplies online without the need for bricks and mortar. There is some risk because the online community is in its infancy, but Jim predicts demand will expand quickly. Tom is impressed, so he starts doing his homework and is soon buying the stock again. Investment footprints. If you picture in your mind the price action of JCB Superstores, you may recognize 3 chart patterns: a double bottom, a double top, and a dead cat bounce. To knowledgeable investors, chart patterns are not squiggles on a price chart. They are the footprints left by the smart money. The footprints are all they need to follow as they line their pockets with greater and greater riches. To others, such as Tom, it takes hard work and pavement pounding before they dare take a position in a stock. They are the ones making the footprints. They are the smart money that is setting the rules of the game, a game anyone can play. It is called investing. Whether you choose to use technical analysis or fundamental analysis in your trading decisions, it pays to know what the market is thinking. It pays to look for the footprints. Those footprints may well steer you away from a cliff and get you out of a stock just in time. The feet that make those footprints are the same ones that will kick you in the pants, waking you up to a promising investment opportunity. This book gives you the tools to spot the footprints, where they predict the stock is heading, how far it will travel, and how reliable the trail really is. The tools will not make you rich. Tools rarely do. But they are instruments to greater wealth. Use them wisely. The database. Let me tell you about the stocks I used to compile the statistics in this book. 1,396 stocks were used. Most start in July 1991 and extend to 2020. Not all stocks covered the entire period. Some stocks no longer trade. It's important to include what happens when a company goes bankrupt or merged out of existence. All stocks use daily price data, not intraday, but some chapters use weekly or monthly data. Most chart patterns were added in real time as new data arrives each day. This avoids look-ahead bias, where I only catalog patterns I can see have done well. The real-time addition of data was done for more than 20 years. All stocks have been split adjusted unless I no longer actively follow them. When a new stock is added to the database, it may have been dividend adjusted by the data provider. However, I don't adjust stocks I use in my database for dividends. A stock becomes part of the database provided it trades above $5 a share, usually, isn't thinly traded. I like to see daily volume over 100,000 shares, and the stock has a heartbeat, meaning it has a reasonable high-low yearly trading range. Market capitalization varies with all 3 represented: small, medium, and large. Most stocks chosen are from American companies whose stocks trade on the NYSE or NASDAQ exchanges. The sample trade. Most of the sample trades included in the chapters of this book are fictitious. Each sample trade uses techniques I wanted to illustrate, incorporating fictitious people in sometimes unusual circumstances. Call it poetic license, but I hope they give you some ideas on how to increase your profits or minimize your losses. Maybe you'll find them entertaining too. Testing chart patterns. How do you test chart patterns? It's not an easy question to answer. If you use commonly available software that tests trading strategies, you'll enter rules to model the shape of a double bottom, for example. When price closes above the top of the pattern, it signals an entry, so the software simulates a buy. What about the exit signal? When do you sell? Should you use a stop-loss order or a signal from MACD or even a moving average crossover? No. Why not? Because you're not testing the chart pattern. You're testing how well a stop-loss order works, or you're testing MACD or the moving average crossover system. So I invented 2 tools I call the ultimate high and ultimate low to solve the testing problem. Let's look at a chart so I can explain how these work, and you'll understand the statistics in this book. Figure I.1 shows 2 chart patterns, a double bottom and a head and shoulders top. Let's take the double bottom first. Trading the double bottom. It appears at AB, 2 valleys that bottom near the same price. A buy signal occurs when price closes above the top of the pattern. The top of the pattern is at C, and the entry signal, breakout, happens at D when price closes above the top of the double bottom. Entry is made the next day using the opening price, which is 17.6. Let's say you're using traditional software and place a stop loss order a penny below the low price of B, which is 15.70. The computer watches the stock rise to E and then drop. When it touches the stop loss order at 15.70, which happens at F, it closes out the trade. So this trade entered at 17.06, sold at 15.70, and took a loss of $1.36 a share. Does this mean the double bottom lost $1.36 a share? No, it means the stop loss order lost that much. You tested the stop loss order, not the double bottom. What do I mean? Pretend that when price climbed to E, you raised the stop loss order to 17.43, which is the high price of G. When price dropped to 17.43, the stock sold, and it handed you a gain, this time of 37 cents a share. Did the double bottom make a profit? No. The stop loss order did. As you move the stop loss order around, you get different sell prices. You're not testing the double bottom. You're testing how well the stop loss order works at different values. So we haven't answered the basic question, how do you test chart patterns? Given the same entry signal, 7.06, let's say you traded this stock perfectly. Where would you sell? When price slides below F, you'll be taking a loss if you have to sell. So trying to shoot for 19 on the upper right of the chart isn't optimum. The trade goes negative for a while before it shows a profit. Ultimate high. How about selling at E when price peaks? That would give you the most profit before the stock dropped into loss territory. That peak is what I call the ultimate high. If you traded this stock perfectly, you'd buy at 17.06, using the opening price the day after an upward breakout, and you'd sell at the high price at E. I'm not testing how well a stop-loss order works because I'm not using a stop or MACD or a moving average crossover system to find the exit. I'm selling at the highest possible price before things go wrong. I'm selling at the ultimate high. A perfect double bottom trade. How do I automate this? In my software, I use two rules to find the ultimate high on a historical price chart, not real time. 1. Find the highest high before price drops 20%, measured from the high to the close. 2. If price closes below the bottom of the chart pattern, then the search for the ultimate high stops, and we use the highest high found after entering the trade. In this example, the stock drops to F and closes at 15.70. The low at B is 15.71, so price has closed below the bottom of the pattern at F. We use Rule 2 to find the ultimate high. The highest high between the entry price, 17.06, and F, the bottom of the pattern, is E. E is the ultimate high. Let's pretend the double bottom is much lower so I can tell you how Rule 1 works. Let's also assume that the close at J is at 13. Rule 1 says to look for the highest high before price drops 20%, measured from the high to the close. The high between the buy price and J is E at 17.80. So we look for price to close 20% below this, or 14.24. When price closes at or below 14.24, again, assuming this happens at J at 13, we found the ultimate high, which is E at 1780. So we bought at 1706 and sold at 1780 and made a profit of 74 cents a share. We didn't use a stop-loss order. We didn't use MACD or the moving average crossover. We executed a perfect trade by buying exactly when we should have and selling at the ultimate high. We tested how well the double bottom worked if you traded it perfectly. And that's how I measured how bullish chart patterns work. Years ago, someone asked me if this was the same as placing a trailing stop-loss order 20% below the high price. It's not. If you did that, you'd be stopped out at J, the fictitious one at 13, and not E. Incidentally, the 20% value in Rule 1 comes from the idea of bull and bear markets. A decline of 20% from a high in the market averages means it slid into a bear market. A rise of 20% off a market low means it entered bull market territory. I applied that idea to individual stocks when searching for the ultimate high and low. Ultimate low. Finding the ultimate low for bearish chart patterns works similarly. Let's take the example of the head and shoulders top at GEH. We see the left shoulder at G, the head at E, and the right shoulder at H. Price confirms the pattern when price closes below the neckline. Because the neckline slopes downward in this example, not shown, I recommend entering the trade when price closes below the right armpit, which I show as the horizontal line at I. You'd short at the open the next day. If you can program your computer to find head and shoulders tops, that's how you enter a trade. Nothing magical here. What about the exit signal? Again, we could use a stop-loss order, but we already know that's not going to work from our previous example. We'd be testing various locations of the stop and not the chart pattern. So let's find the ultimate low. 2 rules. 1. Find the lowest low before price rises 20%, measured low to close. 2. If price closes above the top of the chart pattern, then the search for the ultimate low ends, and we use the lowest low found after entering the trade. In this case, price breaks out downward from the head and shoulders top, drops to J, and then rises. The low at J is 1460, so a 20% rise is 1752. A close at 1752 or higher will end the search for the ultimate low. When price closes at K, at or above 1752, the search for the ultimate low is over. We found the ultimate low, which is J. If K was a bit higher, then Rule 2 would come into play. That's because price would close above the top of the head and shoulders, stopping the search for the ultimate low. In this example, we are trading this head and shoulders perfectly. We are entering the trade at the opening price the day after a downward breakout, and we are closing it out at the ultimate low, the lowest low before price rises. A perfect trade. We are testing how well this chart pattern works. We're not testing stop-loss order placement or MACD or a moving average crossover scheme. The performance of most of the chart patterns in this book follows these 2 ideas, the ultimate high and the ultimate low. For bullish patterns, I look for the ultimate high. For bearish patterns, I look for the ultimate low. Chart pattern failures. Once you understand what a perfect trade means, you can look for failures. What does it mean when a chart pattern fails? To answer that, I had to invent a new concept, which I call the break-even failure rate, or the 5% failure rate. Those 2 phrases are synonyms. All I did was count how many chart patterns failed to see price rise or decline more than 5%. In a bull market, for example, I found that 18.8% of head and shoulders top patterns failed to see price drop more than 5%. If your cost of trading is 5%, then you'll know that nearly 20% of head and shoulders you trade, if you trade them perfectly and often enough, will fail to cover your costs. Realistic? So there you have it. Once you understand that I'm measuring performance from the breakout price to the ultimate high or low, then you'll understand most of the statistics in this book. You'll understand that the performance numbers are based on perfect trades, made hundreds or even thousands of times to arrive at the average rise or decline I show in table X.2, where X is the chapter number. Are the results realistic? Not really. You likely won't be able to duplicate them in real life. You might do better or worse, depending on your skill and luck. The double bottom example entered the trade the day after the breakout. If you placed a buy stop a penny above the top of the double bottom, you'd be entering at a better price, most of the time, based on my tests, than using the opening price the day after the breakout. So you could do better than the numbers shown in this book. All you have to do is find the price of the ultimate high, weather the 20% drop, wait for a recovery, and sell at a price above the ultimate high. People who buy and hold do that all of the time. For traders, though, it's more difficult. Finding the ultimate high in real time, as it's happening, is challenging. That's why people like me write these types of books. Chapter 1. How to Trade Chart Patterns. This book will help you identify dozens of chart pattern types. It will also do what no other book does, tell you how chart patterns have performed over 3 decades using statistics from hundreds or even thousands of samples. That's not enough. That information won't make you a successful trader, but it will give you an edge over other traders. What's missing? Experience. If you have enough experience trading stocks, you should be able to look at a chart and determine whether it's time to buy, sell, or stay in cash. That's not as difficult as it seems. When you look at a chart, look for a bullish chart pattern, such as a double bottom. If you find one that confirms as a valid chart pattern, then it's time to buy. A confirmed double top means it's time to sell. If you do nothing else except trade those 2 chart patterns, you could make money. buy when a double bottom appears or any bullish pattern, and sell when a double top confirms or any bearish chart pattern. The ride between those two might be bumpy, so you'll need to know how to use a stop-loss order. Add bells and whistles, such as making sure the market is trending upward and the industry to which the stock belongs is also trending upward, and you'll have a smoother ride. Having both of those on your side increases your chance of a successful trade. Complete the picture with a bullish stock aching to rise, and you're good to go. I'll discuss this setup later in this chapter. Let me share with you a few ideas on how I make my trading choices. I'll tell you about a few swing trading setups that work, and then discuss the winners of performance contests. Bottom fishing, buy the dip. When I have cash I want to put to work in the stock market, I'll flip through 600 charts on my computer, looking for anything that interests me. That takes less than an hour unless I find something interesting. Figure 1.1 shows a weekly chart that caught my attention. Why? Before I answer that, let me say that I prefer to bottom fish for stocks. That is, I prefer to buy low and sell high. I'm more successful at bottom fishing than momentum trading. Buy high, sell higher. Ideally, a bottom fishing expedition will yield an investment that turns into a momentum play when the stock soars and continues well into the stratosphere. Some will claim that bottom fishing is a risky play, and they are right. But I argue that momentum trading is even riskier. Only you can decide which practice is best suited for your trading style. I use both, but I prefer fishing because as my portfolio has grown in size, I don't need to trade as much. I can devote my time to living instead of playing video games, watching candlesticks form on the 5-minute scale. Returning to the figure, the stock started out low on the left of the chart and climbed to the right, doubling in value. If you were to ride this chart like a roller coaster, you might exit the ride and stumble around, feeling queasy. When I looked at figure 1.1, I wasn't thinking of buying the dip, but that's what I saw. Price moved horizontally at A. If you ignore the few downward price spikes, the bottom of the portion is reasonably flat, followed by a strong and quick plunge to B. After B, the stock recovered quickly to C and bobbled up and down, eventually rising into the clouds at D. I put the chart aside and flipped to the next stock that caught my attention. Figure 1.2 shows what I found, weekly chart again. My software, which I wrote, groups charts by industry so I can get a sense of how the industry is behaving. I had moved from advertising, figure 1.1, to airline stocks, figure 1.2. There's the same pattern shown on this chart. Point A is a flat base, lasting a long time, over 2 years. A plunge follows, taking the stock down fast to B, and then it recovers. This time, the stock zipped up B to C, but went sideways in 2016 for about 6 months C, before taking off and flying to D in a nice straight line run that saw the stock triple in price. The stock moved sideways again at E, another flat base but shorter, dropped to F, not a fast drop, and soared to G. The EFG move is a pattern similar to the prior two, this chart and the prior figure, but not as clean looking nor as successful. The pattern in figure 1.1 happened in 2013-2014. Pattern AB, figure 1.2, happened in 2013 to 2016, and pattern EF occurred in 2018. In other words, I'm finding the same pattern in different years, which is a good thing, potentially different market conditions. Flat base, sudden drop, and fast move higher. Could this be a winning setup that's worked for years? After finding a number of these patterns, I hunted for those that failed to perform as expected. Figure 1.3 shows an example of a failure, weekly chart. Notice that the flat base at A started in late 2014, the same as the other two charts. Price moved horizontally at A, dropped swiftly to B, and recovered, but only to C before it tumbled to make a lower low at D. After D, though, the stock did take flight and delivered. A pun on the package delivery service, in case you missed it, which was reassuring if you buy and hold, but terrifying for a swing or position trader who bought before C. I looked for other examples and eventually cataloged my results. The research led to a pattern I call a diving board. I hunt for it on the weekly scale, but I've noticed variations of this pattern on the daily charts too. As you look at the three charts, there are differences and there are similarities between them. What's important to performance? Is it the length of the pattern? How far price drops after the flat base? The industry the stock is a member of? Or the time of year, seasonality, or even bull-bear market? By looking at a number of charts, and with the help of this book, you can answer those questions and become a more successful trader. Daily chart setup. Figure 1.4 shows the same pattern in the advertising industry, which is suspicious because it's the same industry as Figure 1.1, but a different period, 2018. The large breakaway gap up in early November, A, was because of third quarter results, which the market liked, hence the bullish gap. After that, price moved horizontally at B and made a strong push lower to C, followed by a headline-fetching rise up to G. Along the way, earnings came out and helped momentum push the stock up, D and E. Near the top, earnings at F sent the stock lower, but only for a day. Perhaps the weak quarter was a warning of a coming trend change. At H, the market disliked earnings and seemed to confirm an end to the upward move, at least for a time. I visited the company's website and found a headline for I near the diving board, titled UBS Global Media and Communications Conference Webcast. I didn't listen to the broadcast, but the stock turned sharply lower a few days later, making a straight line run down to C. I don't know if the webcast was the cause of the decline or what happened to send the stock skittering to C. If you owned this stock at the time, it would have been wonderful if you knew the cause of the drop, from I to C. This chart, on the daily scale, is similar to figures 1.1 and 1.2. You can use these historical charts to formulate how to trade the pattern. If you can time your entry near C, then you can ride price back up to the base of the diving board, B. You can wait for price to close above the highest peak at B and ride price upward to G. Below the bottom of the diving board, B provides a good stop location too. The ride upward to G may not be as smooth as shown on this chart or in figure 1.2 as price climbs from C to D. It might be as treacherous as the climb to D in figure 1.1. When I look at this chart though, I see dollar signs in the form of profit. All you have to do is find this pattern and have the courage to trade it. Another setup. Figure 1.5 shows another setup, but one you should avoid, at least from the bullish side. The setup begins with price making a strong push higher, often in a straight line run, but be flexible as in this example. I show that upward move at A and then B. The uptrend lasts several months and takes price from about 9 to 13, which means a good rise. Price moves horizontally at C, as if trying to catch its breath. Ignore the downward February spike at C. The horizontal move should be proportional to the AB move. If AB shows a breathtaking rise, then expect C to be a long horizontal move while the bulls and bears regroup. In this example, AB is about 4 months long and C is 6 months long. After the topping pattern, C, price forms a chart pattern just below the base of the peak. I show that pattern at DE, a double bottom. The double bottom confirms at F when the doji, hard to see, closes above the top of the peak between valleys D and E. Price climbs only to G before reversing. After G, the stock drops all the way to H. Traders expecting the double bottom to deliver profits to their wallet find holes in their pockets and the money gone. I see this setup a lot. Price moves up, goes horizontal, and then a chart pattern appears, which can be any bullish pattern, like head and shoulders bottom, double bottom, or triple bottom. The pattern confirms as valid and price rises some before reversing and heading lower. The pattern busts its upward breakout, handing bulls a loss. Just recognizing the double bottom, DE, as a tradable pattern isn't enough. If you research the setup by looking at other charts, you'll see how this setup can lead to a failure of a chart pattern. This, the double bottom, or head and shoulders, or any bullish pattern at the end of the horizontal top, is a setup you'll want to avoid. Pothole setup. Figure 1.6 shows a rare setup on the weekly chart, but it's a variation of the pattern shown in the prior figure. The company runs into trouble that lasts for the long term, months. That trouble takes price down from A to bottom at B. At B, the bears want to see the stock continue to drop, but bottom fishers like me see a good value. Buying demand keeps the stock from dropping much farther. A stalemate emerges with neither the bulls nor the bears winning, so the stock just lines sideways, the B to C move. If the B to C move represents a highway, then CD is a pothole. It's a bear trap, though. Price drops to C and makes another bottom at D, forming a double bottom in this example. The CD move can represent any bullish pattern, like a head and shoulders bottom or triple bottom. Anyway, price climbs out of the hole and climbs and climbs and climbs. E. If you're lucky, the stock will rise like it did here, but don't depend on that happening. I also find this example suspicious because it happens in 2013 to 2014, the same period as figure 1.3. Still, it provides the template for the pothole setup. The key to this pattern is the stock forming a bottom, flat base, followed by a pothole. Make sure the flat base appears after a downtrend. You don't want to go long if price trends up into the pattern, like figure 1.5. See if you can find a reason why the stock wants to climb during E in figure 1.6. The reason could be a good quarter with a positive future outlook issued by the company. Maybe the cost of ingredients is going down, or the company can raise prices on the goods they sell because the market for widgets is firming up. If you look back at the figures in this chapter, they all have a flat base, a period of time where the stock goes horizontal. After that horizontal move, a pattern appears. In the first 4 figures, price drops after the horizontal move. In the last 2 figures, a double bottom reversal sends price higher, at least for a time. If you research these setups, that is, find examples in the stocks you trade, that will give you the confidence to trade a similar setup when it appears in a stock you'd like to own. Here's another idea to help ease the research burden. Patterns. I wrote pattern finding software for Windows that I call Patterns and made it available for free to download and use. Visit my website www.thepatternSite.com. One of the things it does is simulate trades. I load up a bunch of stocks, tell it to find double bottoms, as an example, but they happen often, and let the program find them. Then I look at the context, the double bottom in the surrounding price landscape. I'll guess whether to make the trade or stay in cash, and then let the stock play out. It's like day trading on the 1 millisecond scale. You control playback speed. In seconds, I'll know whether the trade made money or not. What I'm doing is training my brain not only to view the chart pattern, but to get a feel for the conditions where the pattern will thrive or fail. It's an easy way to train your brain to recognize winning and losing setups. Suppose you find a stock showing a chart pattern you wish to buy. Spend an hour searching for similar setups using the pattern simulator, and you'll be able to tell whether your trade will likely work or not. It's easy to find chart patterns. The pattern software will find them for me. But having the experience to know whether they will work is what separates a seasoned professional from amateurs. Amateurs are the ones paying for the dreams of the professionals. Stop giving away your money. Take the time to do the research to discover when a chart pattern will work and when it won't. Then put that knowledge to use to fill your wallet or purse. That's how you trade chart patterns and make money doing it. Another way, I mentioned this setup in the introduction to this chapter. Look for a bullish pattern and buy it when it confirms. Sell when a bearish pattern appears. For example, figure 1.7 shows a double bottom at AB. The 2 valleys bottom near the same price. The squiggles turn into an actual double bottom when price closes above the horizontal line. That happens at C, the breakout. The next day, D, you buy the stock at the opening price and receive a fill of 740. From then on, you look for a bearish pattern, one that says the stock is going down. A double top appears at EF. The 2 peaks top out near the same price. It confirms as a valid double top when price closes below the horizontal line, G. The next day, you sell your shares at the open and receive a fill at 1060. The difference is $3.20 or 43% above the buy price. In fact, if you had spotted an earlier double top, I, you could have sold a day after the downward breakout, J, and received a slightly better fill at 11.00 for a net gain on the trade of 49%. If you sold the day after J, you might be kicking yourself for selling too soon. Why? Because price continued to rise to E and higher to F. If you were astute, you may have recognized a 2B pattern at F and sold sooner, making even more money. Don't look for the 2B pattern in this book because I don't review it. Visit my website for details if you're interested in the 2B. Of course, I cherry-picked this trade, and often things aren't as easy as this example suggests. But the idea is simple. Buy bullish patterns and sell bearish ones. Yes, you'll have to find stocks that you believe show promise in an industry doing well and during a rising market. You will want the stock, industry, and market trending in the same direction for the best result. You may want to score the chart pattern too. I described the scoring mechanism in my second book, Trading Classic Chart Patterns. A review of the technique over a decade later shows it still works well. It will help you select patterns that perform better and avoid the duds. Knots and swing trading pullbacks. Let's dig in and discuss some swing trading setups. Figure 1.8 shows what I call a knot. It's a useful way of detecting when a pullback will start and at what price. It's ideal for swing traders who want to make money when price breaks out downward from a chart pattern in its initial push lower. Let's look at Steelcase on the left of the figure. A double top forms at AB and confirms at C when price closes below the horizontal line. How low will the stock drop in its initial descent? Answer: to the knot at D. I define a knot as a place in a strong trend, E to A in this example, where price moves sideways for at least 3 days. When it's the first knot closest to the double bottom, the first location of support, really below the pattern's breakout, expect the stock to bottom there and begin a pullback. In this example, knot D is the first support area below C. Price reaches the area at F and begins to pull back to the price of C. In my experience with knots, I know to place an order to close out the trade at the top of the knot, not the middle or bottom. Sometimes, price touches the top of the knot and reverses. At other times, the stock drops like we see here at F before reversing. Setup 2. Let's take the case on the far right of the figure, Setup 2. In the rise from I to H, there is no knot of support. The uphill move is fast and long. The way to trade this is to split the move in half and place an order to close out the trade there. In this example, midway up the run from I to H is J. Place an order to cover a short at J. After the double top FG confirms when price closes below H, price drops to K before beginning a pullback. You don't see this setup often because there is usually a knot along the uphill run from I to H, but it does happen. Take advantage of it and expect the stock to find support midway in the I to H run like it does here at J. If the run does show a knot but it looks too far below the chart pattern, then split the run in half like I've explained. In technical terms, if support is too far away, then price will reverse closer to the chart pattern. What is closer? Most pullbacks bottom in the 7% to 8% range. If a knot is 10% or 15% away, then that's too far unless there's a fundamental reason to drive price down hard and fast. Bad earnings, bad future outlook, that kind of thing. If the move from I to H is exceptionally long, you might want to split the run into thirds and place a trading order a third of the way down to I from H. Search for other stocks showing the same pattern and see where they turn. The pattern simulator can make the search easy. Setup 3. Another setup is similar to Setup 2, except there's support between J and H, but not in the same upward trend. Let's rewind the tape and start at the beginning. Imagine that the line separating Setup 3 from Setup 2 is missing. We see a strong move higher from I to H. We could take half that move and assume price is going to drop back to that area, just as we did in Setup 2. However, looking to the left of I, we see peak L. It's a mean-looking knot of support, with price going horizontal for a week or two, but need not be that extensive. A simple, well-defined top can do. Instead of using Setup 2 to place the exit trade midway at J, it's more likely that the stock will drop to the price of L and reverse there. So L is our target. We place a stop a penny above G, place our order to short a penny below the price of H, and use the top of L as the exit. Knots and throwbacks. Figure 1.9 shows two more scenarios for swing trading the stock. The left panel shows a double bottom at AB, confirmed when price closes above C. As a swing trader, you don't want to wait to buy into this situation, so you place a buy stop a penny above C. That gets you into the trade right on time. How far will price rise? Answer: to D. That's the first knot. The knot is the closest region to the breakout, where price moves horizontally for at least 3 days. That horizontal movement is obvious because it rests in the circle to the left of D. D is your short-term swing target. The stock will rise and hit that region and likely turn back to the breakout in a throwback, which it did in this example after reaching E. You can set a limit order to sell at the top of the knot, but the bottom of the knot works better, less risky. In this case, it did work better when the rise to E triggered the order and sold the position. You don't make a lot of money trading the throwback, 7 or 8%, so you might have to increase the position size to make it worthwhile. Do place a stop-loss order a penny below the lower of the two bottoms, below A in this case. Setup 2. The prior setup captures the run-up to the throwback. What if you want to capture more of an advance? This is a more risky setup, but it also works well. Look for the second higher knot. I show that at F. That's your target. In this case, the knot is composed of peaks, a ragged top with price spiking upward. Price also moves sideways here for at least 3 days, with lots of overlap, so it's a good area of overhead resistance. The stock recovers from the throwback and rises to G, where it hits resistance set up by the second, higher knot F. After that, price struggles to push through that resistance, but eventually does in this example. Setup 3. The right half of the figure shows a similar setup. A small double bottom is at HI, confirmed when price closes above J. It's hard to see where that is, though. In this setup, we have a measured move down pattern from L to K, first leg. K is the corrective phase, and KH is the second leg. We know from studying measured moves that price returns to the corrective phase 77% of the time. See Table 46.5, where 23% remain below the corrective phase and 77% move higher. We know price is going to climb to K. K becomes our target. We use a buy stop a penny above the high at J, a limit order to sell at K, and place a stop a penny below the low at H. Test these setups in the stocks and markets you trade. Make adjustments accordingly so that they work for your trading style. Performance contests. Imagine Dave likes to bowl, and he plays 3 games per match. Over a month, he competes 5 times and wins 3 out of 5 matches with 1 tie. If we tally his win-loss record not for the 15 individual games, but for the 5 matches, we find he wins 75% of the time, 3 of 4 contests with 1 tie. We might conclude that he's a good bowler, or those competing against him are not. I built the following tables just like I described with Dave. They show how often an aspect of a chart pattern leads to better or worse performance. Table 1.1, Reversals versus Continuations, shows the results of the first contest. Which types of patterns perform better, those acting as reversals or continuations? Before I answer that, what is a reversal and a continuation? A pattern acting as a reversal happens when price enters and exits a chart pattern from different directions, down going into the pattern and exiting out the top, or rising into a pattern and breaking out downward. Patterns acting as continuations see price enter and exit the chart pattern in the same direction, down going into the pattern and breaking out downward, or rising into a pattern and exiting upward. For example, Figure 1.7 shows double bottom AB acting as a reversal because price drops into the pattern and leaves it going upward. The downtrend reverses. The rectangle at C in Figure 1.2 is a continuation pattern. Price rises into the start of the rectangle from B and exits out the top. That is, price continues in the direction of the prevailing price trend. Winner. Table 1.1 tells us that reversals work best after upward breakouts and continuations work best after downward breakouts. For example, I found 55% of chart patterns acting as reversals outperformed continuation patterns in bull markets after upward breakouts. Almost all, 87% of the chart patterns after downward breakouts in bull markets showed patterns acting as continuations beating those which acted as reversals. Performance. This line in the table shows the average gain or loss for the contests. For example, reversals in bull markets after upward breakouts gained 43%. Continuation patterns saw price rise 42%. Notice that the differences between the contests are often narrow. Continuations, for example, lead by 1 or 2 percentage points. The narrow lead is a warning that the indicator is weak as a predictor of future performance. Table 1.2, Height. Do tall patterns outperform short ones? Tall or short is a measure of the height of the chart pattern divided by the breakout price. Winner. This line shows how chart pattern performance varies with height. I contend that tall patterns outperform short ones, and we find that belief is true in all market conditions and breakout directions. For example, tall patterns win all of the contests, 100%, after downward breakouts in bull markets. Performance. The performance averages are wide too, with tall patterns gaining an average of 46% and short ones gaining just 39%. Bull market, up breakout. I believe height is a key indicator of future performance, so you'll want to trade tall patterns and avoid short ones. Table 1.3, Width. Do wide patterns outperform short ones? I measure width from the start to the end of the pattern. Winner. The numbers in the table tell how well width works as an indicator of chart pattern performance. Contests from patterns in bull markets perform better when they are wide. Bear market patterns show a tie. Performance. Most performance differences are marginal, 1 or 2 percentage points. For example, after downward breakouts in bear markets, wide patterns see price drop 23% on the way to the ultimate low, but narrow ones see price drop an average of 22%. Thus, width is not a strong predictor of performance, but it can give you an edge in bull markets. where performance differences are wider. Table 1.4, Breakout Day Gap. Do gaps that occur on the day of breakout help performance? Winner, performance. After downward breakouts in bull markets, I found that 85% of the chart pattern types showed a gap helping performance. The chart patterns dropped an average of 16% versus 15% for those not showing a breakout gap. Notice that the percentages on the performance line are close, suggesting gaps are not a strong performance indicator either. Because I measure performance using the opening price the day after the breakout day gap, you can participate in the better performance that a gap may provide. Table 1.5, Throwbacks and Pullbacks. Throwbacks and pullbacks are features I love. When they appear, they invariably hurt performance. The table shows the blood. A throwback happens after an upward breakout from a chart pattern when price soars, but then returns to the breakout price or comes close to it within a month. Pullbacks are the same, except the breakout is downward. Winner, performance. For example, 97% of the time, I found that throwbacks hurt performance after upward breakouts in bull markets. In contests of patterns with downward breakouts in bear markets, all of them, 100%, showed that pullbacks hurt performance. The average decline of those contests was 26% for those patterns not showing a pullback, N, and 20% for those that did pullback, P. For a downward breakout, that's a wide difference. Occurrence. The occurrence line in the table shows how often a throwback or pullback occurred, on average. Throwbacks and pullbacks happen almost 2 out of 3 times, 63% to 65%. Table 1.6, Rising or Falling Volume. The table shows how patterns behave if volume is rising or falling from the start of the pattern to the end, found using linear regression. Winner. For upward breakouts, performance improves just over 60% of the time if volume is rising. Downward breakouts are mixed with bull markets in patterns showing falling volume doing best, but bear markets show a tie. Performance. The performance numbers are close though, especially for downward breakouts. For example, patterns with rising volume R saw price climb 44% to the ultimate high, bull market up breakout. Patterns with falling volume F showed gains averaging 42%. The volume trend is not a good predictor of future performance. I think technical analysts put too much emphasis on volume. Consider that for every share sold, one is bought. If institutions are selling massive amounts of shares, then other institutions are buying those shares. Table 1.7, Heavy versus Light Breakout Day Volume. I compared breakout day volume with the prior month. Winner, performance. The table shows that heavy breakout day volume suggests better performance most of the time. For example, I found that 79% of the time after upward breakouts in bear markets, high volume led to better performance by 29% for heavy volume versus gains averaging 26% for patterns with light breakout day volume. You will notice that the percentage difference is not great, especially after downward breakouts, which show ties. Breakout volume is not as good a predictor of performance as many believe. Table 1.8, Trend Change. This table is different from the others. It shows how often price continues rising or falling more than 20% after the breakout. My thinking is that if a chart pattern shows large post-breakout moves, then it should be easier to make money trading them. Conversely, a pattern that has lots of small moves may be difficult to trade profitably. Occurrence. Only in bull markets do the majority, 55% of chart pattern types, see price rise more than 20%. The worst performance, 28%, comes from chart pattern types with downward breakouts in bull markets. That poor performance makes intuitive sense because the market trend is upward, but the breakout is downward. It's like swimming against the current, so you'd expect the swimmer to struggle. Notice that downward breakouts in bear markets place second, 49%. It's another indication that trading with the trend, upward breakouts in bull markets and downward breakouts in bear markets, leads to better performance. Table 1.9, Single Busted Patterns versus Proxy. The final table in this chapter shows how well busted patterns perform against non-busted ones. Winner. Single busted patterns outperform their non-busted counterparts a good portion of the time. That's especially true for chart patterns in bull markets. They win more than 90% of the contests. Bear markets also win contests, but at a more sedate pace. Performance. I compared the performance of single busted patterns with their proxy P, the non-busted pattern. In most cases, the performance difference is quite wide. For example, in bear markets after downward breakouts, single busted patterns with downward breakouts saw price rise an average of 40% above the top of the chart pattern. The non-busted patterns saw price climb just 28% on average. Occurrence. This line tells how often a single busted pattern happens versus double or more than 2 busts. The higher the number, the easier it'll be to trade a busted pattern that wins big. That means you are more likely to trade a single busted pattern than a pattern that double or triple busts. Bull markets with upward breakouts show fewer single busts, 53% than the others. I think that's because when the pattern busts, price will be heading lower, and that's going against the bullish current. It invites a double bust. The chapters that follow look at individual chart patterns. I use statistics to help discover how they behave, and I share my findings with you. End of Chapter 1. Chapter 2, AB equals CD bearish. Results snapshot. Appearance, a 3-leg zigzag pattern with 2 turns located by Fibonacci ratios. Downward moves. You'll need a computer to find this pattern unless you're incredibly fast with a calculator and have lots of time to waste searching for the thing. If you have access to a computer with pattern recognition software, then this pattern is as plentiful as hair on a gorilla. If your software is better than mine, or you have special sauce that you can add to the ingredients, then your pattern may behave differently than the ones I studied. I measured performance of Fibonacci-based patterns differently than I do other chart pattern types. That's because we're looking for a reversal at the end of the pattern and not an up or down breakout. Therefore, the layout of this chapter is different from most other chapters in this book. The bearish AB equals CD performs in 2 ways. First, if you know the first 3 turns, ABC, then you can anticipate at what price the last turn, D, will appear. This works well, with price reaching D nearly all of the time, 95% of the time or more. Second, once price reaches D, it's supposed to turn lower. My tests show this doesn't work well, only 32 to 38% of the time. As I mentioned, this could be a flaw with the model I used. Your software may perform differently. Let's run through the rest of the results snapshot for the bull market. You can compare the results with the bear market. I measured the drop from the peak at turn D, the last in the pattern, to the ultimate low. Of the 5 bearish Fibonacci-based patterns I studied, this one performs worst in the bull market when price drops just 12.7%. The break-even failure rate is 26.3%, which is high. That means price fails to drop more than 5% over a quarter of the time. Volume trends downward, but it's close to random. Let's take a closer look at this pattern to discover what this mysterious point D is and what the pattern looks like. Tour. The bearish AB equals CD is a Fibonacci-based pattern, meaning Fibonacci ratios determine the turning points. Figure 2.1 shows an example of a bearish AB equals CD pattern. The pattern appears as turns ABCD on the chart. In this example, leg AB's height is similar to the height of CD, hence the name of the pattern. In the ideal case, you'll see leg CD equal AB. Often, however, the CD leg may be a Fibonacci extension away, meaning point D can be far away from the other 3 turns. That's not a flaw. Rather, that's just the way the pattern is constructed. The duration, days, of AB should also equal the CD duration in the ideal case. Here we see leg AB lasting 6 calendar days and CD lasting 8. That's quite close, isn't it? Most of the time, like I described for price, point D's date can be far removed from the other points. In well-behaved patterns of this type, the slope of the AB line should be similar to the CD slope, with a retrace in between. That's almost what you see in Figure 2.1, but it's seldom that pretty. In fact, you can see some bizarre-looking AB equals CD patterns even though they qualify as valid Fibonacci patterns. Volume trends downward in this example, shown on the chart as E. This ABCD is a good performer. Price completes a tidy and compact-looking pattern, and then price falls, making an extended decline into December. That's how the pattern is supposed to behave. Let's go through the guidelines for identifying these patterns. Identification Guidelines. Table 2.1 shows identification guidelines for the chart pattern, and Figure 2.2 shows a typical example. The pattern appears in the figure as ABCD. Appearance. As I mentioned, the shape of the bearish AB equals CD can look weird when point D is far from the ABC turns. The figure is an example of that asymmetry, but not an extreme one. Leg AB is 36 days long, so you might expect, or hope, the CD move to also be that long. It's not. CD is 66 days long, or almost twice the AB duration. It'll be rare that leg CD matches the length of AB. Just because CD is almost twice as far away as AB doesn't mean the pattern is invalid. Rather, the turn is determined by the Fibonacci number used to locate it. Let's talk about the Fibonacci ratios. BCAB retrace. Retrace BC compared to the height of BA is governed by the Fibonacci numbers listed in the table. Let's give your slide rule a workout and go through the math. The low at point A is 56.81, and the high at B is 63.85 for a height of 7.04. The low at C is 60.32. I tuned my software to find a turn within 0.011% of one of the numbers listed in the table, so we get 63.85 to 60.32, 63.85 to 56.81, or 50.1%. That value is almost exactly the 50% retrace, 0.5. So the ABC turn meets the guidelines. DC-BC extension. If you invert the ratio found in the last step, you use it to find the price of D. In this example, we found the closest Fibonacci number to be 0.5, so we'd expect point D to be twice as far away. To put it another way, let's pick a point D where the ratio of DC to BC is 2. The high at point D is 67.36, so the equation is 67.36 to 60.32. For 63.85, 60.32, or 1.99, or about 2. We found turn ABC to obey one of the numbers listed in the table, and we also found point D using a Fibonacci extension, one of them listed in the table, so we found a valid AB equals CD pattern. In this example, price turns down at D, just like it's supposed to. However, the drop is brief to E. Hills and valleys. I excluded any pattern that had a peak or valley outside of the turns as described in the table. Volume. Although it may not look like a downward volume trend in this example, F, linear regression says it recedes. In fact, you'll see volume trending downward in most AB equals CD patterns and other chart pattern types too. If volume trends upward, that's fine. Don't throw away a pattern because of an unusual volume trend. Duration. I imposed a 6-month limit to the length of most chart patterns, including the AB equals CD. It's an arbitrary limit. Focus on failures. Figure 2.3 shows an example of a failed bearish AB equals CD pattern, labeled as turns ABCD. The pattern fails in multiple ways. The first is that price doesn't make it up to the predicted point D. Turn A has a low price of 134.82, B has a high of 148.28, and C has a low of 139.95. That gives a BCBA retrace of 0.618, so the turn qualifies as a valid AB equals CD. It predicts that point D should be at 153.41 using the formula. D equals B minus C, where ratio plus C. As the figure shows, point D falls well short of the target, which I show as F. Instead, price rises only to D before dropping to E. Imagine that you wanted to trade the anticipated rise to point D by buying the stock soon after turn C. You placed a stop a few pennies below C, and you would have been stopped out at E, which reached a low of 139.79. Slightly below the low at C. As I mentioned in the identification guidelines, there can't be a low below C on the way to the calculated point D. Point E stops the search for D because it's below the low at C. If you ignore that rule, then you have discovered the second failure type. The second way this AB equals CD fails is when price continues rising instead of turning at D. If we ignore the lower low violation at E and assume price climbs to F, where turn D should be, 153.41, then look what price does. It continues rising, doesn't it? So price fails to turn at the new target D and moves to G, peaking at 158.77, well above the 153.41 target. Shorting the stock at F would have tested a trader's courage against a rising price trend when the stock climbed to G. Look back at figure 2.2, where it shows another example of how the pattern fails to see price decline much after D. Price drops from 67.36, point D, to 65.22, point E, a drop of 2.14 points or 3%. Could you make money shorting the stock at D, knowing that if you traded it perfectly, you'd make 3%? If you owned the stock long and sold at D thinking price would drop, you'd be happy that the stock dropped to E. But your joy would turn to sadness when the stock continued climbing up to F and beyond. It would say you'd made a mistake. Of course, I chose figure 2.3 to highlight the failure of this pattern to perform as expected. That's what the Focus on Failures section is supposed to do. In the next section, we'll see what the numbers say about how this pattern behaves. Statistics. Table 2.2 shows general statistics for the bearish AB equals CD and tailored to the Fibonacci pattern. That means you won't find explanations for the table entries in the glossary. Most are self-explanatory. Number found. If you can program your computer to find them, you'll discover that they come out like worms after a heavy downpour. They were so plentiful that I limited the number cataloged per stock. I found the first pattern in February 1990 and the most recent in February 2020, finding them in 884 stocks. Not all stocks covered the entire period, and some stocks no longer trade. Break-even failure rate. For those patterns that see price make it up to D and reverse there, this is a measure of how often price fails to drop more than 5%, below the high at D. The bull market value is high, ranking 4th out of 5 where one has the lowest failure rate. But the bear market rate at 10.2% is the worst of the 5 bearish Fibonacci patterns I looked at. Average decline after D. This is a measure of the drop after point D for those patterns seeing price make it up to point D and reverse there. As one would expect, the drop in bear markets is larger than in bull markets. If you were to trade the bearish AB equals CD pattern perfectly and frequently, this is how much you could make on average. Commissions were not included. Volume trend. I used linear regression from the start to end of the pattern and found it trends downward most of the time, but it's near random. Performance up-down volume. I checked performance when volume was trending up or down. This applies only to those patterns that turn down at D. The bull market shows no performance difference, but in bear markets, the performance difference is wider and substantial. Patterns with downward sloping volume see price drop an average of 24% compared to a 19% decline for those with upsloping volume. Trading tactics. The AB equals CD pattern can be a wonderful tool to help predict when price will turn and then make a substantial decline. Once you know the first 3 turns, you can determine when and at what price the 4th turn will appear. And when turn D appears, the stock will drop. Does it really work like that? Let's find out. Table 2.3 shows how price behaves after point D. How often does price reach or exceed D? I checked how often price climbed far enough to reach the calculated price of D. The table shows that nearly all of the patterns reached the target turn. That's terrific. Swing traders can use this to predict how far price will rise. They can even trade it by buying at the low at C and riding price higher to D. How often does price turn at D? I checked each pattern to see if a minor high formed at the calculated point D. I found that only about 1/3 of the time will you see price turn lower at the calculated price of D. Because we know price rises to D nearly all of the time, we can assume that price continues beyond D instead of turning lower when it should. This finding is not a deal breaker. Now that we know price will likely continue rising, we can just stay in our trade when we bought after turn C and ride the stock upward until it does turn. How often does D appear within a week of calculated time? The pattern can work as a predictor of when point D will occur, as well as the price of the turn. I found the dates of the ABC turns and found the ratio of CB to BA. Then point D followed the equation. D equals C minus B, wire ratio plus C using dates instead of price. I found that between 43% and 45% of the time point D appeared within plus or minus a 2-week window, a week of when it was supposed to. Because the numbers fall well short of the expected time, I don't think this measure is helpful. How many drop to? If price reaches D and turns down, we know that the average decline measures between 12% and 22% from table 2.2. Let's measure how far price drops in terms of turns A, B, and C. Point B is closest to turn D, so we would expect the stock to drop that far most often. Indeed, the table shows that price reaches turn B between 76% and 87% of the time. Price will drop to C less often, 35% to 46% of the time, and reach the bottom of the pattern, point A, even less often. Using these values, we can get a sense of how far price might decline. It could be less or more, depending on the situation, of course. But at least we have a roadmap. Sample trade. Figure 2.4 shows a sample trade using the AB equals CD pattern. Jacob poked me in the ribs, then pointed to the screen to discuss his trade. See that? It's a double bottom. His fingers traced the twin bottoms at EA with a nice peak F between them. I can make money trading that. He placed a buy stop a penny above F. That order triggered at G, putting him into the stock near the breakout price. Immediately, he placed a stop a penny below the lower of the two bottoms, which in this case was A, at 37.112. If the trade went bad, he'd lose about 10%. That's bigger than the 8% I like to see. But you have to be flexible, he told me. For about a week, the stock cooperated and climbed to B before starting to retrace. The throwback and drop to C made me nervous. I started sweating bullets because I thought I'd be stopped out. Don't believe me? The sweat started pouring off me, and the furniture started floating. I'm not kidding. You can see the watermark. He pointed to a smudge on the wall. His wide grin made the Grand Canyon look like a small ditch by comparison. I thought of selling, but I invariably sell a week or two before the stock bottoms. It's annoying. What helped me this time was when I noticed the bearish AB equals CD pattern. His software helped by providing the location for him. Let's run through the numbers. The low at point A was 37.113, the high at B was 43.144, and the low of price bar C was 38.42. Crunching the numbers said that the ratio of BC to BA was 43.14 to 38.42, 43.14 to 37.13, or 78.5%. That was close to the 78.6% Fibonacci number, so the turn matched the identification guidelines. Table 2.1. If the pattern worked as he hoped, the CD leg would equal or exceed the AB leg and make for a tasty profit. The height of the AB move was 43.14 torn to 37.13, or 6.01. Added to the low at C, 38.42, gave a target for turn D of 44.43. I doubled my position right there, he said, and poked the screen, leaving a fingerprint behind. The second buy was near C, and he set a target to sell both positions at 44.43. I raised my stop too to a penny below C, just in case. The stock took off in a straight line run up to D. The stock sold at the exact high at D, 44.43, cashing him out of the AB equals CD trade and also out of the double bottom trade. Let's do lunch, he said. I'll let you buy. End of chapter 2. Chapter 3. AB equals CD, bullish. Result snapshot. Appearance. A zigzag pattern that has 4 turns, 2 of which are governed by Fibonacci ratios. Upward moves. The bullish AB equals CD pattern is a type of measured move down, except that the pattern's turns are determined by Fibonacci ratios. I measured performance of Fibonacci-based patterns differently than I do other chart pattern types. That's because we're looking for a reversal at the end of the pattern and not an up or down breakout. Therefore, the layout of this chapter is different from most other chapters in this book. The theory behind this pattern is that if you know the first 3 turns, A, B, C, you can calculate the 4th turn, D. The method works nearly all of the time, meaning price does fall to the calculated point D. However, when price reaches D, it fails to reverse there. Only about a third, 33% in bear markets and 38% in bull markets, will see price turn upward when it's supposed to. Of course, your software for identifying the bullish AB equals CD may be different than the model I built, so your performance may vary. Add trading rules to improve performance, and you may find this pattern a useful tool. Let's see what this pattern looks like. Tour. Figure 3.1 shows an example of a bullish AB equals CD. Price begins the pattern at peak A after an exhaustion gap warns of the coming retrace. The pattern completes at valley D, with turn BC nestled comfortably between those 2 points. Notice that price turned at D and climbed from there, at least for a time. Price reversing at D and climbing is how the pattern is supposed to work. In this example, price broke out of the pattern upward at F when it closed above the top of the pattern. Not shown, but the stock continued higher to rise 199% above the low at D. If only all chart patterns worked like that. This chart is also a good example of the CD leg meeting the projection of AB. In other words, the height of AB subtracted from C gives turn D. Thus, if you know turns ABC, you can estimate where D will appear. However, you can also use that price information to predict where D will be using Fibonacci numbers, because turn D can be far away from the ABC turns. I'll discuss that in the next section. Notice volume E trends downward in this example. A downward volume trend happens 47% of the time in a bull market, meaning an upward trend is slightly more likely. An upward volume trend helps boost performance, and we'll see how much in the statistics section. Identification guidelines. Table 3.1 shows the identification guidelines, and Figure 3.2 shows an example of a bullish AB equals CD pattern. Appearance. Bullish AB equals CD patterns are a member of what I call Fibonacci patterns, whose turns are set by Fibonacci ratios. I don't suggest you try finding this pattern manually. Rather, use pattern recognition software that can hunt down these patterns like a cat hunts mice. I found so many in my quest to count them that I ran out of fingers and toes and had to limit the number a stock could report. CBAB retrace. The BC retrace of AB should be one of the Fibonacci numbers listed in Table 3.1. Let's use the pattern shown in Figure 3.2 as an example of how this works, rather how I wrote my software to find these patterns. The high price at A is 228.89, the low at B is 213.112, and the high at C is 225.45. The CBAB ratio is 225.45 by 13.2, 228.89 to 21112. Or 0.782, which is darn close to the 0.786 number in the table. It qualifies as a proper turn. My software looks for a number within a window 0.5% of the target numbers listed in the table. Once you know the ABC turn, you can determine what D should be priced at. In this example, D equals C nice A as B, or 209.68, which is close to the actual low at D of 209.62. CDCB extension. Point D can also be found by the formula C minus C minus B, Fibonacci number, or 225.45. This 25.45 minus 213.786 in this example. The result is 209.76. Hills and valleys. The table explains the requirements of peaks and valleys between the various points in the pattern. Volume. Volume trends upward from points A to D most often, but the trend is almost random. Duration. I limited patterns to 6 months duration or less. This is an arbitrary limit. Focus on failures. Figure 3.3 shows one example of how this pattern fails. The 4 points in the pattern are labeled as ABCD, and they comprise the bullish AB equals CD pattern. Volume slopes upward in this example, shown by the diagonal line at E. Point D is where the stock is supposed to bottom and turn upward, but it doesn't. It's obvious that the height of CF is much taller than AB, but the height can vary depending on the Fibonacci numbers used in the construction of the pattern. The turn at D should be at 40.05, and yet the stock continues lower. This type of failure happens often, 62% of the time in bull markets and 67% of the time in bear markets. Let me also say that this high failure rate may be due to the model I used. Your software may find patterns that perform better than the ones I found. Another way the pattern fails is if the stock doesn't make it down to D. It turns before the predicted target, leaving you waiting to buy the stock with a fistful of money. Fortunately, this type of failure is exceedingly rare. Finally, the pattern can also fail if it does make it down to D and it does turn at D, but the rise isn't high enough to make money. These types of failures are what I call 5% failures and describe them in Table 3.2 as the break-even failure rate. Let's check the statistics to see what we can learn about this pattern. Statistics. Table 3.2 shows the first batch of statistics for the bullish AB equals CD. Number found. I found over 2,300 patterns sorted by market condition in 1,069 stocks from July 1991 to February 2020. I told my program to limit the number found so it didn't overload my spreadsheet. Not all stocks covered the entire period, and some no longer trade. Break-even failure rate. The failure rate, a measure of how many patterns failed to see price climb more than 5%, is quite good, averaging between 3% and 12% of those patterns that reached D and reversed there. To put it another way, if you were to trade a lot of these patterns perfectly, you'd have an 88% chance of seeing price rise more than 5% above the low at D. That's terrific. Average rise after D. I measured the average rise from the low at D for those patterns reaching D and turning upward. The average rise is disappointing. Non-Fibonacci-based patterns in bull markets perform better, averaging 42.4%. However, bear markets beat non-fib patterns with the rise averaging 30.5% compared to 28.1% respectively. Volume trend performance. Volume trends upward slightly more often than downward, as the table shows. You can improve performance by looking at the volume trend. I used linear regression to determine if volume was trending upward or downward from the start to end of the pattern, A to D. Often, you can just look at volume to see the trend. Both markets see an improvement in performance if volume trends higher. To put it another way, a downward volume trend hurts performance. Trading tactics. Imagine if you found a pattern that could predict when the stock is going to turn. That's what I had hoped for this pattern. Once you know that the stock had bottomed, you could buy and ride it higher. Does the stock really turn when it's supposed to? And how high does the stock rise? Let's find out. Table 3.3 shows statistics regarding the behavior of price after the pattern ends. How often does price reach or exceed D? If you use the pattern to predict turn D, then price will hit the target nearly all of the time. The 100% hit rate in bull markets is a round-off thing. I found 3 patterns out of 1,741 where the stock failed to drop down to the calculated D. So it does fail to reach D, but it's very rare. That's the good news. It reaches D. How often does price turn at D? Here's where the pattern stumbles. For those stocks dropping to D, only about a third will turn when they are supposed to. Figure 3.3 shows an example of this when price ignores D and continues lower to bottom at F. How often does D appear within a week of calculated time? Using the first 3 turns to predict the time when turn D will appear works about half the time. It could be better, but sometimes having a clue when something will happen can improve your trading. Use this idea just like I explained with price in the identification guidelines. That is, find the ratio between the time to move from B to C compared to the time to move from A to B. Point D should appear following the formula, C minus B, where ratio plus C, where ratio is the number you just found. I'll discuss an example of this in the sample trade. How many rise to? For those patterns seeing price drop to D and turn upward, how far does price rise? The answer to that question is vital for swing traders. I use the pattern's turns to gauge success. Point B is closest to turn D, and we see price climb that far 83% of the time in bull markets. That's very good. Use A, which is at the top of the pattern, and we see that price makes it up that far less than half the time, 40%. Hopefully you can use the information in these tables to help improve trading results using Fibonacci-based patterns. Sample trade. Figure 3.4 shows a trade George made. His computer program found the AB equals CD pattern on the way down to D. Let's go through his buy decision. The pattern appears at turns ABCD on the chart. The high at point A is 6.65. The low at B is 5.81 for a height of 84 cents. Subtracting the height from the high at C, 6.55, gives a calculated turn D of 5.71. The high-low range at D is 5.94 to 5.59. It's the first point where the stock drops below the target, and it accurately marks the turn. So that becomes point D. Let's see if we can predict when the stock will reach D. Point A is 9 November 2009, B is at 8th of December, and C turns at 16th of December. The ratio of CBBA is 8/29 or 0.28. That's the ratio between the two legs. For point D, we use the formula D equals C as B ratio plus C, or 8 or 0.28 plus 16 December 2009. Turn D is predicted to appear on the 14th of January 2010. In this example, turn D appeared on 20th of January, and that's within a week of the predicted time. I consider that a good prediction. Volume sloped downward as Z shows. Even though volume slopes upward most of the time in an AB equals CD pattern, the direction is nearly random, 53%. He made this trade in a bull market. The bear market ended in early 2009. And Table 3.2 says a falling volume trend penalizes performance, but only by about a percentage point, dropping from 38.4% to 37%. He used the traditional measure rule for chart patterns to estimate how far price would climb if the pattern broke out upward. The height of the pattern is AD, 6.65 to 5.59, or 1.06. So the target would be 1.06 plus 6.65, or 7.71, which is the height added to the high at point A. A downward breakout would be D, 1.06 or 4.53, or 19% lower. When the stock made a strong push upward at E, he told me, I bought at the open the next day and received a fill at 602, and I just ate breakfast too. He grinned. I scratched my head. The stock filled? Ate breakfast. Get it? I exhaled, rolled my eyes, but said nothing. With a calculated rise to 7.71, he was looking at a potential gain of 18%. That sounds reasonable, he said. For grins, he calculated a new target based on half the height, 1.06 top, or 0.53 added to the high at A, or 7.18. If he sold at the closer target, he'd make 9%. Let's look at the historical chart. He punched keys on his computer and pulled up a chart from 2007. Overhead resistance here, he pointed and swept his finger across the screen. Price moved horizontally for a year. Looks like a cloud bank pattern. Before the bear market started and sucked the stock down. If the stock worked as he hoped, it would have to traverse through that resistance to reach the full height target. Am I asking too much for price to rise that far? A check of table 3.3 didn't set well with him. With just 38% of patterns showing a reversal at D, he decided to place a tight stop a penny below the low at D, 5.59, 0.01, or 5.58. The trade went bad right from the start. The day I bought, the stock closed lower, almost reversing the move up at price bar E. 4 days later, he pointed to F. The stock hit my stop and cashed me out at 5.58 for a loss of 7%. That's 1 day before it bottomed. The day after he was stopped out, the stock began a rebound that carried the stock up to the full height target, 7.71, shown on the chart as point H. Looking back at the trade, the AB equals CD pattern found point D accurately and on time within a week of the prediction, but the stock broke out downward at F, not upward. It busted the downward breakout when it closed above the top of the pattern, above A, and continued higher to reach the full height target H. End of Chapter 3. Chapter 4. Bat Bearish. Result snapshot. Appearance. Looks like a big W with turns located by Fibonacci ratios. Downward moves. Every time I see a bearish bat pattern, my first thought is it's a big W chart pattern. It's as if the big W was computerized and the developer used Fibonacci ratios to determine the turning points. The bat pattern joins other Fibonacci-based patterns, AB equals CD, butterfly, crab, and Gartley. I measured performance of Fibonacci-based patterns differently than I do other chart pattern types. That's because we're looking for a reversal at the end of the pattern and not an upward or downward breakout. Therefore, the layout of this chapter is different from most other chapters in this book. The above result snapshot gauges the downward move after the pattern ends. The stocks I looked at saw price turn lower 86% of the time after reaching point D. That percentage is not good, but great. The average decline in bull markets is a hair over 14%. The break-even failure rate isn't too bad at 17.7%. That means an average of almost 18% of the bearish bats will fail to see price drop more than 5% below the high at D, end of the pattern. All of this may be confusing unless you can see what a typical bat pattern looks like. So let's take a quick tour. Figure 4.1 shows an example of a bearish bat. The pattern begins at X, which is any significant turn. The locations of points A and B follow, but their placement is determined by one of two Fibonacci numbers. Once points X, A, B are found, the search for C can begin using one of 6 Fibonacci numbers. Following that, if you're lucky, D will appear close to one of 4 Fibonacci numbers. One last number, 0.86, helps validate the pattern. All of that gibberish means this pattern is complicated, and that makes it rare. If you're handy with a slide rule, remember those? Then you'll be wasting your time searching for a bat. Even using a fancy electronic calculator will take too much time to find a bat. Use a computer with pattern finding software. I have a free one on my website called Pattern Z, which will find this pattern and dozens of others. Try using it if you're serious about finding bats. Even for a bearish bat, this example looks weird because of the uneven bottoms A and C. Volume trends upward E when Table 4.2 says the average pattern shows a downward trend. As bad as this bat looks, it performs exceedingly well, with price dropping to F. This bearish bat is indeed bearish. A swing trader taking a position just after D forms and watching the stock go all the way down to F might start dreaming about bats. Maybe even build some bat houses and hang them on his or her property. Here's a hint: a nearby pond is a plus. Let's return to trading bats. First, we have to find them. Identification guidelines. Table 4.1 shows identification guidelines. The guidelines are similar to other Fibonacci-based patterns, except the turns may use different numbers. Figure 4.2 shows another example of a bearish bat. Appearance. My guess is that the name comes from the picture, which forms when you connect turns X, A, B, C, D with lines, but also includes lines connecting X, B, and BD. The pattern looks like two wings. When trying to visualize this, consumption of alcohol may be a plus. As I mentioned, the pattern's turns are found using Fibonacci numbers. Let's go through this pattern to see how the bat in figure 4.2 qualifies. BA-XA retrace. The ratio of leg BA to XA should be either 0.382 or 0.5. Here are the prices used in the retrace or extension calculations for the bearish bat. The high price of point X is 56.93. The low at point A is 47.81. B peaks at 52.1. C bottoms at 49.71, and the pattern ends at D with a high price of 55.98. To determine the retrace, I use the height high-low range of the price bar at the target to determine whether or not it spans a Fibonacci number. For example, the BA-XA turn using the high price of B would be 52.0 to 47.81, 56.93 to 47.81, or 0.46. Using the low price at B, 50.92 in the equation, gives 50.90 to 47.81, 56.933, 47.81, or 0.34. The range 0.34 to 0.46 straddles the 0.382 Fibonacci number, so I allow it as a valid XA turn. Using this method gives a lot of leeway to the pattern's turns, but even so, the pattern is rare. Trying to narrow the turn window would limit even more patterns from being found, so this is the algorithm I chose. The software you use may think differently. BCBA retrace. In a manner similar to the BA-XA retrace, I plugged in the numbers for the BCBA retrace using the low at C. They are 52 to 49.71, 52 47.81, or 0.55. Using the high at C, 51.65, gives 52 51.65, 52 47.81, or 0.08. The range of 0.08 to 0.55 encompasses 0.382 and 0.5, so I allow the turn as valid. DC-BC extension. In a similar manner, I find the DC extension of BC. That's 55.98 points, 49.71 reverse, 52, 49.71, or 2.74. Using the low at D54, we get an extension of 1.87. The 1.87 to 2.74 values straddle all of the listed numbers, any one of which will suffice, except 1.618, so it qualifies as a valid extension. DAXA retrace. Supposedly, this ratio is critical, so I allow point D to miss the number by 3%, 0.03. I do not use the high-low range of D in the equation, and I use 3% instead of 1% because this pattern is rare enough as it is. We have 55.98 to 47.81, 56.93 to 56.93, or 0.9. The 0.9 value is near the 0.886 target, so the pattern qualifies as a valid bearish bat. As you can imagine, computing these ratios by hand is tedious and error-prone. So I programmed my computer to find bats by first finding all peaks and valleys and then using the method described to glue them together. Volume. I'll discuss a few volume statistics in Table 4.2, but volume trends downward in the pattern most of the time. With few samples, it's difficult to say whether up or down trending volume leads to better or worse performance, but current statistics favor a downward volume trend for the best performance. Duration. I limited patterns to a length of 6 months or less. That's an arbitrary limitation. Focus on failures. Figure 4.3 shows a failure of a bearish bat pattern. Why is it a failure? As the name implies, bearish bat, not bullish, price should drop after point D, meaning price should trend lower after the pattern ends. However, price continues trending higher in this example. price closes above the top of the pattern, X at point E, posting an upward breakout. I checked the statistics and found that 70% of the 665 bats I looked at break out upward, regardless of the market condition, bull or bear. Don't let that number give you nightmares. As awful as the 70% number is, it doesn't tell the complete story. Swing traders will soon learn, as discussed in Table 4.2, that price turns lower at point D 86% of the time. Price may still break out upward, as Figure 4.3 shows, but maybe you can make money when price drops between D and the breakout. I don't show this situation in Figure 4.3, but if price does turn lower at D but drops less than or equal to 5%, then that's also a failure. If you were to trade a pattern with a 5% failure, you'd be hard-pressed to make money. The 5% failure rate, also called the break-even failure rate, is 17.7% for this pattern in bull markets, but just 4.5% in bear markets. Since I'm throwing around a lot of numbers, let's discuss statistics. Statistics. Table 4.2 shows general statistics related to the bearish bat pattern. Number found. Despite using the high-low price range at most of the Fibonacci turns, as I discussed in the identification guidelines, few bats appear in the historical price record. I found them in 491 stocks, despite searching from June 1991 to August 2019. Not all stocks covered the entire period, and some no longer trade. Break-even failure rate. I counted the number of patterns which saw price drop no more than 5% after peaking at D, using the high price at D to the ultimate low. The table shows the failure rate. Anything above 0 is too high, but that's in an ideal world. The bear market failure rate at 4.5% is terrific. The 17.7% failure rate in bull markets is not so terrific. When you consider that a declining price trend in bull markets is like swimming against the current, you would expect a high failure rate. Swim with the bear market current, and the failure rate drops to 1/4 the bull market rate. Average decline after D. Point D ends the pattern, and price is supposed to head lower. The average decline is 14.3% in bull markets, but substantially better in bear markets, over 20%. Volume trend. Performance. I measured the volume trend using linear regression, but often you can tell the trend just by looking at the chart. Figure 4.2, for example, shows volume E higher on the left half of the pattern than the right half, so the trend is downward. In fact, the average bearish bat will have a downward volume trend at least most of the time. Does the volume trend give us any hint of better or worse performance? Not that you'd notice. The widest spread between the two numbers is 1 percentage point in bull markets. That's probably not statistically significant. Trading tactics. The real purpose of the bearish bat is for swing traders to predict the turn at D and then go short, anticipating a drop to the bottom of the pattern. Will price sink that far? Maybe, maybe not. Let's look at some number to see if we can model behavior better. Table 4.3 uses numbers to show how price behaves after the pattern completes at D. How often does price turn at D? At the end of the pattern, price can form a minor high at D, or price can continue trending upward, as in a straight line run up. Most of the time, 86%, the stock will form a minor high at D. To find the reversal rate, I checked for a minor high appearing there. That is, I checked to see if price actually turned lower. Figure 4.3 shows an example where the stock failed to turn significantly lower at D. How many dropped to? This measures the drop after D, but uses the pattern's turns as targets. For example, I found that in bull markets, the stock reached turn B 81% of the time. Turn B is the closest turn below D, so it should, and does, have the highest hit rate in the table. At the bottom of the pattern is point A. Price reaches A just over 1/3 of the time. You can use these findings to help calculate where your stock might turn. Because you're dealing with probabilities, anything can happen. Sample trade. Figure 4.4 shows how Pete used a bearish bat. He bought the stock when it broke out to a new high, at E, the highest price bar on the chart. "Don't laugh," he told me. "How many of these zingers have you got caught in?" I didn't say a word, but blushed instead. Many years ago, I bought a stock and watched it more than double. Wonderful, but I felt it had more to give, so I held on. It lost all of its gains, dropped in half, and I sold near the low. Oops. Then it recovered. Of course it recovered with me watching from the sidelines. So I know how Pete feels. Maybe you do too. As traders, we all make mistakes, and that's the beauty of experience. It allows you to recognize a mistake when you make it again. Pete believed in the company and had profited over the years by holding on to the stock. He checked in every few weeks and saw price continuing to move lower. The decline didn't bother Pete. Why? Because it's a chance to buy the stock at a lower price, like it's on sale. He made a fortune using the buy the dip method to trade stocks. That is, buy when price makes a significant dip. The problem with that logic is that the stock has to recover. I have faith, he said, and pulled out a cross draped on a necklace strung around his neck. He kissed the cross and then tucked it back under his shirt. Pete's computer alerted him to the bearish bat pattern, which formed as labeled on the chart XABCD. With additional shares, he decided to trade the throwback, which didn't occur in this pattern. He set a buy order to grab 1,000 shares a penny above X, not D, or 159.37. The stock gapped open higher, breakaway gap, and he received a fill at the open at F at 163.25. He used a limit order to sell his 1,000 shares at 5% above X, or 167.34. The next day, the order filled. He made just over $4,000 in 2 days. Of course, if he'd held on to the shares and sold at the ultimate high in late January 2020 at 327.85, he would have doubled his money. That's for a perfect trade, of course. If he'd held during the COVID-19 bear market and sold at the late March 2020 low, he'd still pocket almost $50,000. End of Chapter 4. Chapter 5. At Bullish. Result snapshot. Appearance. Looks like a big M with turns located by Fibonacci ratios. Upward moves. The bullish bat is a big M chart pattern, except that Fibonacci ratios determine the turning points. I don't show bear market statistics in this chapter because I found just 53 patterns. That's too few to be worth discussing, especially when sorted into different categories. I found 259 bullish bats in the data I searched. That's too few to be comfortable drawing conclusions, but let's live dangerously, shall we? I measured performance of Fibonacci-based patterns differently than I do other chart pattern types. That's because we're looking for a reversal at the end of the pattern and not an up or down breakout. Therefore, the layout of this chapter is different from most other chapters in this book. The results snapshot previous page shows the average rise from the low at turn D is 44.3%, which is quite good. That beats the 42.4% average gain for non-Fibonacci-based patterns. Failures at about 10% of patterns are also quite good. They are well below the 15.3% failure rate for non-Fibonacci patterns. Swing traders will want to buy long at turn D. Price turns upward at D 91% of the time in the bats I looked at. That's sensational. It's a headline performance. The performance rank, which is based on the average rise from point D when compared to other Fibonacci patterns, is first out of 5. It's the best performing Fibonacci pattern. The performance rank of bear market patterns, not shown, is also first best out of 5 contenders. Tour. Figure 5.1 shows what a bullish bat pattern looks like, one that performs better than expected. The pattern has 5 turning points, cleverly labeled X, A, B, C, and D. Why is X labeled as the first turning point? I haven't a clue. I'm too lazy to find out, and that's the convention. So that's what I use. In Figure 5.1, the bat appeared when price formed a second bottom at X, mirroring the valley in October. Price recovered to the top of a trading range set up by prior peaks and valleys, and hit turn A, the top of the pattern. Price found overhead resistance there that it couldn't overcome. So price retraced in an ABC-type consolidation, that is a drop to B, upward retrace to C, and drop to D. The stock broke out upward at F when price closed above the top of the pattern, pushed through a ceiling of resistance, and soared. Volume trended upward, which I show at E. This is one of the few bats to show an upward volume trend. Based on the average, bats with an upward volume trend tend to underperform. I will discuss statistics later in this chapter. Identification guidelines. Table 5.1 shows the identification guidelines for the bullish bat. Use figure 5.2 as a reference. If you don't have a computer that can find these patterns, give up now. Go search for a big M or double top instead. They are easier to find because you don't have to do any calculation. Plus, bats are as rare as Klingons on Vulcan, or so I assume. I haven't visited there recently. Figure 5.2 shows a bullish bat at turns XABCD. This one sees price climb after D, but breaks out downward at E. Appearance. If you draw lines connecting turns XA and back to X and connect BCD and back to B, you'll notice that the two halves form a set of wings. Imagine a body at B, and it'll resemble a bat, or butterfly, or birds, or lots of other flying creatures, I think. But this pattern is called a bullish bat, so that's the story I'm sticking with. Without the lines, the pattern looks like a big M chart pattern, or even a double top with tall sides. The difference between the bullish bat and those other patterns is the use of Fibonacci ratios to determine the turning points. So let's discuss that next. AX retrace. Let me give an example of how to find the various points. Points X and A are arbitrary minor low and high points, respectively. Minor low B is an important one. The ratio of leg AB to AX should be either 0.382 or 0.5. Because the pattern is so complicated, the rules determining valid ones limit the numbers you will find in the real world. So I used the high-low price range of one of the points in the ratio. If a Fibonacci number is within the high-low range, then it's allowed as a valid turning point. For example, the low at point X is 9.76. The high at A is 12.90, and the high-low range at B is 11.81 to 11.40. The ABAX ratio using the high at B would be 12.90, 11.81, 12.90, 9.76, or 0.35. Using the low price at B would give 12.9 to 11.4, 12.9 to 9.76, or 0.48. The 0.382 number nestles comfortably between 0.35 and 0.48, so XAB is a valid turn. CBAB retrace. In a similar manner, I use the high at A, low at B, and high-low range at C, 12.57 to 11.98, to qualify the CBAB retrace. Plugging in the numbers, we get a range of 0.39 to 0.78. That range must encompass one of the numbers listed in the table, and it does. In fact, several of the numbers listed fall within that range. Although such a large range might seem like the recognition rules are lax, only a few patterns qualify. Let's continue with the CD extension. CD-CB extension. CD is longer than CB, so we call that an extension and not a retrace. Let's go through the math for this one. It follows the same rules as before. I use the low at B, high at C, and the high-low range at D to qualify the 3 points. D is at 10.81 to 10.19. Plugging them into the equation, we get 12.57 is 10.81, 12.57, 11.40, or 1.50 using the high at D. The low at D becomes 12.57, 10.19, 12.40, or 2.03. Two numbers fit that range, 1.618 and 2, so the turn qualifies. ADAX retrace. For the last turn of the bat, I don't use the high-low range. Rather, the number must be within 0.03 of the target 0.886 value, using the low at D only. So we get 12.90 to 10.19, 12.90 to 9.76, or 0.86, which is within 0.03 of the 0.86 target. This pattern qualifies as a valid bullish bat, but your software may use a different algorithm and find a different result. Volume. The bullish bat doesn't have a volume requirement. Rather, you'll see volume recede from point X to D, the width of the pattern, most of the time. I'll discuss volume in the statistics section. Point F in the figure shows a downward volume trend. Duration. There are no rules limiting the width of the pattern, but I limited them to 6 months. Focus on failures. Figure 5.3 shows a bullish bat that fails to be bullish. I show the 5 turns at XABCD. It's a valid bullish bat, even though it looks weird. Price at D should see the stock turn higher, but it doesn't. It does form a minor low, but that doesn't translate into any meaningful rebound in the stock. Instead of turning upward at D, the stock continues lower, breaking out downward at E. Price continuing lower at D, instead of turning upward, is the first type of failure. The second type of failure is when price does turn upward at D but doesn't climb far. I consider a move no more than 5% to be a failure. Figure 5.3 shows this type of failure too, because price climbs just 3% after D. 5% failures only happen about 10% of the time, so they are a concern, but not a huge one. Let's talk about statistics next. Statistics. Table 5.2 shows a few general statistics for the bullish bat. Number found. This complicated pattern is rare, but it could be the result of the way I program my computer to find them. I unearthed bats in both bull and bear markets in only 260 stocks, despite searching over 1,300 stocks. Patterns found in the stocks stretched from July 1991 to April 2019. There were so few patterns that I limited the presentation to bull markets only, as I mentioned. Break-even failure rate. The break-even failure rate is a measure of how often patterns fail to rise more than 5%, as measured from the low at D. With such a high average rise, 44.3%, you might expect to see a low failure rate. Indeed, that's what the pattern shows, at 10.2%. Average rise after D. The average rise measures from the low at point D. The 44.3% rate compares favorably to the 42.4% average rise from non-Fibonacci-based patterns. Volume trend, performance. Volume trends lower 80% of the time as measured from the start of the pattern to the end using linear regression. Performance is best if the trend is downward, with rises averaging 47%. However, don't let the wide difference, 35% and 47%, between the two values fool you. I found just 27 samples with upward volume trends, which is probably why the 35% gain is so tiny. The difference between the two values will shrink with more samples. Trading tactics. Are you a swinger? Swing trader, that is. If so, then the following table is just for you. With this pattern, you can use your software to calculate at what price D would need to appear to complete the bat. Then you can wait to see if it appears. If it does, then consider buying the stock and riding price higher. But how often does the stock turn upward at D, and how far up does price rise? Those are important questions any swing trader wants to know. Here's what I found out. Table 5.3 shows how price behaves after point D. How often does price turn at D? I found price turning upward at D 91% of the time, which is wonderful. It's exciting. Swing traders will be delighted when I share the news, I'm sure. How many rise to? Gauging performance using another method, I checked how often price climbed to the various turns in the pattern. For example, the closest turn to D is B. I found that price climbed to B 86% of the time. At the top of the pattern is point A. How many climbed to A? Answer: 58%. Even though just over half of bats saw price reach A, with an average rise of 44%, it's clear many bats see price rise substantially to overcome the stinkers trying to pull the results down. Hopefully, you can use these numbers as guidance to help you trade this pattern better by estimating how far price might rise. Sample trade. Figure 5.4 shows a sample trade that Scott made. Scott has been a longtime admirer of Apple products, so when his software flagged a bullish bat, he took an interest in the stock. I show the bat as turns XABCD. I measured the height of the pattern, he said, and pointed to the chart. From the peak at A, 60.96, to the low at X, 50.61, the height was 10.35. His statistics on bullish bats showed there was a 60% probability that the stock would climb to 71.31. Which is the height added to peak A. The 60% number comes from the traditional way of gauging chart pattern performance using the measure rule. Price reaches the target 60% of the time when you add the height of the pattern to the top of it. You might not believe this, but I really didn't care about the answer. I wanted to hold the stock for the long term, but having that background info is reassuring. Scott is also a fan of trend lines. For entry, he drew a trend line skirting the peaks going down to turn D. The day after D, the stock closed above the line, signaling a buy, with the belief that the bearish bat had found a bottom at D. Here's where I got creative. I used the bullish AB equals CD chart pattern to find that turn D was overdue. It predicted a bottom priced at 53.34, located in the area gap at G, so that gave Scott more confidence that the stock had put in a bottom at D. Regardless, he bought the stock at the open the next day and received a fill at 53.66. I placed a stop below the low at D and below 52.0. Know why? Before I could answer, he said, because at 51.83, it's 7 cents below D, and it avoids the round number 52. That's where others might place their trades. The stock cooperated and moved higher, forming a slightly upward curving trend. I show that on the chart, log scale, as a series of 3 lines rising toward E. When the stock closed below the trend line near E, he placed an order to sell the stock at the open the next day. He received a fill at 87.14 for a gain of 33.48 a share, or 62%, not including commissions. I got lucky on this trade, he told me. Why? 2 reasons. First, because the stock might not have turned upward at D. And second, I forgot to raise my stop. That's not always a bad thing, especially for long-term holds. If you're swing trading or short-term trading, then consider using a trailing stop, one that price stalks as it moves upward. Another lucky factor was how the stock behaved with price rising in a near straight line run up to E. Although the stock retraced after E to 74.60, it went on to a new high at just over 100 in September 2012. The stock need not have dropped far at E before moving higher too. Still, for a relatively short-term trade, the exit was timely and the entry was delicious too. Isn't there a Red Delicious brand of apple? Get it? He traded Apple stock. End of Chapter 5. Chapter 6. Big M. Results snapshot. Appearance. 2 peaks near the same price form a pattern that resembles an M. Downward breakouts. The Big M chart pattern is a variation of a double top, a twin peak pattern with a tall left side. In well-behaved patterns, the right side will also be tall, so that the pattern resembles a tall M. The pattern confirms when price closes below the valley between the 2 peaks. We'll see a picture of the pattern in a moment. Big M's only break out downward, but they appear in both bull and bear markets. The average decline is about what you would expect from a bearish chart pattern, higher in bear markets than in bull markets. Volume trends downward from the first peak to the second, but plays no role in performance. Volume devotees may find that odd. The performance rank for Big MS is good in bull markets, but slips in bearish ones as the above statistics show. Let's look at some examples to see if we should include them in our trading toolbox. Tour, figure 6.1 shows a good example of a Big M chart pattern. Price begins climbing to the first peak in the pattern from the launch price at A. Think of point A as the launch pad with the hope that price will return to the pad after the pattern completes. In perfectly shaped Big M's, the price trend to the first peak is a straight line affair, often quite fast and steep, like you see here on the way to peak B. The Big M is a twin peak pattern, BC. It's similar in shape to a double top, except for the tall sides, as I mentioned. Between the peaks is a recession, D, a valley where price bottoms. The stock recovers and forms a second peak, C. After the second peak, price drops and breaks out when price closes below the valley between the 2 peaks. That happens at E in this example. The stock continues lower but then gets sucked back up to G. It's a pullback, which often returns the stock back to or near to the breakout price in 12 days on average. A pullback is not part of the Big M. Rather, it's just something that occurs about 2/3 of the time. Traders need to be aware of it so that they don't close out a position prematurely. In well-behaved Big Miss, price drops after the second peak in a straight line run down to the launch price, mirroring the rise to the first peak. That behavior represents the ideal situation, so don't depend on that happening in real life. In this example, the stock drops farther than the launch price, bottoming at F. Many times, however, price will bottom just above the launch price. Identification guidelines. Table 6.1 shows the identification guidelines for the Big M. Figure 6.2 provides another example of a Big M at BD. Price begins the rise at A, the launch price, which is the second bottom of a nicely shaped atom and atom double bottom. Along the way, price gaps, an exhaustion gap because price consolidates after the gap, just past midway to the first peak and forms a pennant before resuming the climb to B. Price meanders up and down as it searches for a bottom at C. The valley between BD looks like a mutant head and shoulders bottom. The left shoulder is LS, the right shoulder is RS, with head C between them. It's not an ideal head and shoulders because the two shoulders don't bottom at the same price. At peak D, price gaps lower, breakaway gap, as if it can wait to reach grandma's house at E. The stock bottoms at E, which is just above the launch price A. Notice that in this example, the rise from A to B is similar to the drop from D to E. That behavior rarely happens, so consider this a textbook example. Appearance. Look for two peaks that top out near the same price. The two peaks likely won't share the exact same price, but they should be close. Use your best judgment and be flexible. If the right peak is higher than the left, performance improves but only by a percentage point. Oddly, performance is best if both peaks share the same price. Between the two peaks, price forms a valley. I didn't set a limit on how far down the valley price slides, but the median height is about 12% in bull markets. After the second peak, price drops, but often won't fall as steeply as it climbed on the rise to the first peak. In perfect patterns, the slope of the rise to the first peak will mirror the drop after the second peak, as I mentioned. In real life, it takes twice as long to drop from the second peak to the ultimate low as it did to climb from the launch price to the first peak. Price trend. The price trend leading to the first peak should be unusually tall, often a straight line run up at a steep slope. As a good gauge, I looked at the height from the higher of the two peaks, D, to the valley between the two peaks, C. The upward trend leading to the first peak, A to B, should be a multiple of the peak to valley height, at least 1 times the height, but 2 times is better, CD. Volume. Volume trends downward from the first to the second peak most often. Don't discard a big M pattern because it has a rising volume trend. Volume doesn't affect performance. We'll see that later in Table 6.6. Breakout direction, confirmation. The pattern breaks out downward. A breakout happens when price closes below the low price of the valley between the two peaks. I show the breakout where price closes below line G. A downward breakout confirms the big M as a valid chart pattern. If price does not break out downward, then you don't have a big M. Duration. The length of the pattern, from peak to peak, varies from about a week to nearly a year. I often limit pattern width to 6 months, but the longest I cataloged was 254 days. I'm sure I can find wider ones, especially if I use a weekly scale. I prefer daily. Focus on failures. Figure 6.3 shows what a big M failure looks like. Price begins a long climb at A toward peak B. The drop to C and recovery to the second peak D is typical for a big M. Contrast dip C with the sloppy head and shoulders valley in figure 6.2. So far, the chart pattern looks perfect, a textbook example of a big M. Let's look at the volume trend, G. It slopes upward. Uh-oh. But a rising volume trend in a big M doesn't have any impact on performance, so who cares? At E, price breaks out downward when it closes below C, confirming the big M pattern as a valid chart pattern. However, the stock bottoms at E. What happened? A trader shorting the stock would become a body on the way to the morgue if they didn't close out their trade promptly. Price steamrolled higher by 131% on its way to being taken over by another company in January 2020. Notice the breakout day volume. I drew a line from the breakout E to the volume bar directly beneath H. Yes, volume is higher on the breakout day, but it is less than the 1-month average, according to my computer, and it's never lied so far. The statistics say that breakout volume for big MS doesn't help or hurt performance. So that's another yawn, and it's not really a performance clue either. Price rises after E and busts the downward breakout when it closes above the top of the pattern, at F, a breakaway gap. This is another example where bearish selling pressure wasn't high enough to overcome bullish buying demand. The bulls didn't buy like crazy and push price higher. That's clear from the anemic volume surrounding the breakout, but the stock moved up anyway. The failure of this stock to stage a meaningful decline at E happens 14% of the time, and this is one example. A busted big M happens 38% of the time, so that's more alarming. Let's talk more about numbers. Statistics. Table 6.2 shows general statistics for the big M. Notice that the tables are not split into up and down breakouts. That's because valid big M's don't have upward breakouts, at least not in this universe. Number found. I uncovered most Big M patterns manually by searching through more than 1,700 stocks, finding Big M's in 772 stocks from mid-1991 to September 2019. I also automated finding them and checked each one to be sure they adhered to the ID guidelines. That process helped to unearth the stinkers, like the one shown in Figure 6.3, where the pattern has a nice left side rise but a mutant right side decline. Reversal, R, continuation, C, occurrence. All of the patterns acted as reversals of the uptrend by definition. Average decline. Both bull and bear markets show performance that beats the average of all other chart patterns, but not by an amount that Mom would like to hear about, especially at 3 in the morning. Standard and Poor's 500 change. Using the same hold time from the breakout to the ultimate low as the associated Big M, we find that the Big M dropped substantially more than the S&P 500 index. To put it another way, you can see how the general market helped the individual stocks perform. Days to ultimate low. The median time to reach the ultimate low is a month for bull markets and about 3 weeks for bear markets. The table shows the average, which is longer in both bull and bear markets. Speed trap. I checked price velocity and found that bear markets see price drop almost twice as fast as bull markets. How many change trend? As a measure of how well the chart pattern works, trends, I counted how many Big M's saw price drop more than 20% after the breakout. The thinking here is that a 20% move represents a trend change. For example, if the markets are bullish, a drop of 20% turns the market bearish. I applied the same measure to chart patterns. As the table shows, higher numbers of Big MS see price drop more than 20% in bear markets as opposed to bull ones. This makes intuitive sense. It's like a receding tide will lower all boats. I consider values above 50% to be exhilarating. Table 6.3 shows how failure rates climb for small drops after the breakout. For example, 298 Big MS, or 14% of the patterns in bull markets, failed to see price drop more than 5% after the breakout. Over a third, 37%, failed to see price drop more than 10%. In bear markets, the pattern performs better, with 37% failing to see price drop more than 15%. You can use this table to help determine the chance of price making an extended decline. Want to make 50% after shorting your Big M? Good luck with that. Only 2% in bull markets see price drop that far. That is, 98% fail to see price drop that far. Table 6.4 provides breakout and post-breakout statistics. Breakout direction. As I mentioned, if a Big M breaks out upward, then you have a case of mistaken identity. Valid Big M's only break out downward. Yearly position, performance. You will see the Big M pattern appear anywhere in the yearly price range. Bull markets seem to find them hiding near the yearly high almost half the time. Bear markets see the breakout price hibernating in the middle of the yearly price range most often. Mapping performance over the yearly price range doesn't see any statistically significant differences. Pullbacks. A pullback occurs after a downward breakout. Price must return to the breakout price within a month by definition. The table says that price drops 7 to 10% in 6 days and then returns to the breakout price in a round-trip total of 12 days. Patterns without pullbacks perform better than do those with pullbacks. That behavior is not unique to Big MS. We've seen it in other species of chart patterns. After a pullback completes, it resumes dropping 55% to 60% of the time on average. Gaps. Breakout day gaps don't help or hurt performance much. Notice that the gap size in bull markets is almost twice the size of bear market gaps. That's a surprise. I measured the median gap size, 19 cents in bull markets and 21 cents in bear markets, and used those as the difference between tall and short gaps. I found that in bull markets, gaps taller than the median saw price drop an average of 19% after the breakout. Short gaps lost just 16%. In bear markets, the results were 25% decline for tall gaps and 21% decline for short gaps. Table 6.5 shows size statistics for the Big M. Height. We see that regardless of the market condition, bull or bear, tall patterns outperform short ones, but not by much. To compute this, measure the height of the pattern from the highest peak to the lowest valley between the two peaks, and divide the result by the price of the lowest valley. If the result is larger than the percentage shown in the table, then you have a tall Big M. Width. Width doesn't offer any helpful performance improvement, although narrow patterns performance is slightly better, but probably statistically insignificant. Measure the width of the pattern from peak to peak and compare it to the 26-day median. If the result exceeds the median, then you have a wide pattern. Height and width combinations. Upward breakouts show better performance if the big M is tall, regardless of width. Tall and narrow patterns outperform in bear markets. Table 6.6 shows that volume doesn't play a key role in the performance of big miss. Volume trend. Volume trends downward every 2 out of 3 trades on average. Rising falling volume. There's no performance difference between big MS with a rising or falling volume trend, as measured from peak to peak using linear regression. Breakout day volume. Only bear markets show better performance after heavy breakout volume. Heavy breakout volume typically leads to better performance for other chart patterns. Not so much with downward breakouts, though. So it's weird that big miss are different. Table 6.7 shows a table new to this edition. How often price hits a stop. I split the pattern into 3 pieces: top, middle, and bottom. The top is the higher of the 2 peaks, B in figure 6.3. The bottom of the pattern is the low at the valley between the 2 peaks, point C. The middle is, well, midway between the top and bottom. In bull markets, price reached the top of the pattern just 2% of the time on the way to the ultimate low after the breakout. Although bear markets show 0%, I actually found 2 samples where price reached the top. If you wish to place a stop, then price will rise up to the middle of the pattern 16% of the time in bull markets, or recover, perhaps during a pullback, to the bottom of the pattern 70% of the time. Bear markets show similar performance. In Table 6.8, I mapped the breakout date into one of 3 decades, which the table shows, split into performance in the top portion of the table and failures in the bottom portion. Because bear markets only happened in the 2000s, they are not included in the statistics. Performance over time. The 1990s showed the best performance from big MS, but not so's you'd notice unless you traded a lot of them. Failures over time. Failures happened at about the same rate over all decades studied, with the 2000s showing the most and the 1990s showing the least. These failures are break-even failures. That is, failure of the stock to drop more than 5% after the breakout. Table 6.9 shows how busted patterns performed. As you will recall, a busted big M happens when price breaks out downward, drops less than 10%, an arbitrary amount, reverses and closes above the top of the big M, above the higher of the 2 peaks. The new upward breakout busts the downward one. Multiple busts can follow. Busted patterns count. Because the sample count for big M's was high, I found quite a number of busted ones, from a sprinkling in bear markets, 18%, to over a third in bull markets, 38%. That makes intuitive sense because the bear market trend will help take price lower. It reminds me of watching a barge move down river. The water level drops near shore and gets all churned up. As a kid, I was afraid I'd be pulled under while swimming or even canoeing, even though the barge was across the river, about a quarter mile away. Busted occurrence. Single busts happen most often, followed by triple busts. While you may find that odd, that double busts don't come in second, you join me in my confusion. I've seen this trend in other pattern types and don't have an explanation for why it happens. A double bust would send price lower. That is, the first bust sends price upward and the second bust turns price downward, if that is any help. Busted and non-busted performance. Grouping single, double, and 3 or more busts together sees price rise 38% after busted downward breakouts in bull markets. Separating out single busts, we see price rise an average of 55% in bull markets. That's measured from the top of the big M to the ultimate high. That's a nice return if you can capture most of it. I used big W's as a proxy for a non-busted big M. They don't see price perform as well as their busted sisters. If you can find a busted big M, buy it and pray that price continues rising for a long time, a single bust. The 55% rise compares to a 46% average gain for big W's, which break out upward. See the table for bear market results. Trading tactics. Table 6.10 shows trading tactics for the big M pattern. Measure rule, targets. I'll give an example of how to use the measure rule for big M's in the sample trade. Use the measure rule to help gauge how far price will drop after the breakout. The rule is no guarantee that price will reach the target. The bottom portion of Table 6.10 shows how often price drops to various pattern heights. For example, using the full height in the measure rule calculation in bull markets, price drops to the target 55% of the time. If you use half the height, the hit rate rises to 80%. Want to live dangerously? Price reaches a target farther away, twice or 3 times the height, less often, as the table shows. Bear markets show similar hit rates, slightly outperforming their bull market counterparts. If you wish to buy the stock long, you can use the measure rule numbers to help determine the probability of a stock dropping to half, 1, 2, or 3 times the pattern's height below the breakout. Just remember that anything can happen. Look for underlying support where the stock might turn and decide if it's worth selling now before it drops that far. Another way to trade a big M is to wait for price to find support after the breakout. Consider buying then and riding the recovery. Don't be fooled into buying the stock during a pullback. After a pullback completes, the stock resumes the plunge 55% to 60% of the time. See Table 6.4. Return to launch price. I also computed the percentage of time that price at the ultimate low met or dropped below the launch price. The last line in the table shows that it reached the launch price just over half the time in bull markets. One challenge of using this method is to figure out where the launch price is. Often it's the same as the trend start. See the glossary. The launch price is the location where price begins rising into the big M in earnest. In the first 3 figures of this chapter, the launch price is point A. In figure 6.4, it's point B. After you determine a measure rule target, convert the potential decline into a percentage of the current price. For example, if the height is $10 and the stock is trading at 50, that's a potential 20% loss, 1050 times 100. Table 6.3 says that in bull markets, big M's fail to see a stock drop more than 20% about 2/3, 68% of the time. That suggests a large decline probably won't happen, but your trade may be the exception. Visit with Table 6.3 and make the check. Stop location. Use Table 6.7 to help determine where a stop-loss order should be located. If you're planning to short the stock, then do use a stop. After you locate the stop, determine if the potential loss is big enough that you might need to reconsider the stop location. If you can't find a reasonable loss value, like 8% or less, then abandon the trade. Another big M will come along shortly. I saw the schedule. Pullback trade. This setup idea should be used only by experienced traders. You can place an order to short the stock a penny below the bottom of the big M and cover at the bottom of the pullback. Table 6.4 can help determine your chance of making money using this technique. In more than 2 out of every 3 trades, 67% in bull markets, from Table 6.4, a big M will show a pullback within a month of the breakout, often in the first week. Price drops for an average of 6 days and returns to the breakout price, or near it, in a round-trip total of 12 days. The drop from the breakout to the low at the bottom of the pullback attempt measures 7% to 10% for bull and bear markets, respectively. If you short the stock a penny below the breakout and place an order to cover the short 5 to 7% lower than the breakout, you might be able to catch the drop and make a profit. The median decline is 6% bull market to 8% bear market in 5 days for both markets. Busted trade. Another way to trade a big M is to buy the stock long if the big M busts. After busting a downward breakout, price soars an average of 55% for a single busted pattern. Even if you only capture half of that, it's still a big gain. See Table 6.9 for details. The trick is to pick single busted trades, so look for overhead resistance within 10% of the breakout price, which might send the stock scurrying for cover. Tips. I don't have any trades in big miss to share with you because I don't like to short stocks. However, I do have some tips I want to pass on from what I've learned studying them in the bush. Look at figure 6.4 with a big M at CE. Notice the knot of support circled at I. If I was shorting this stock, this knot of support would be my first choice for where the stock will turn. The knots need not be midway up from the launch price, but they do tend to be about midway. That is, it's about midway up the move from B to C. What you want to look for is 3 days or more of horizontal price movement. Not a loose meandering of price, but a tight sideways move with lots of overlap. H is a good example of what to look for, but it's often shorter than what's shown. I is a good example. The 2 weeks to the left of B shows a third example of what to look for, not the placement in the BC run, but the type of horizontal move you're looking for. Sometimes it's only 3 or 4 days wide, but it's enough to support price. The knot of support should be the first one below the confirmation price. In this example, D is the confirmation price of the big M. Notice that price drops to F and finds support at I. As a price target, pick the highest price in the knot. Chapter 1 gives a good tutorial on knots, so reread that if you need a refresher. Here's another scenario. Price moves up like you see from B to C. However, the closest knot of support is below the price of a prior peak, looking back a year or two. That prior peak will act as support and the stock will likely turn there. In other words, as price drops, it first finds support at the prior peak. And if it were to continue down, it would then find support at a knot along the BC run. The high price of the peak would be my target. In another scenario, you'll see price confirm the big M and then reverse. Price climbs a few percent, up to 4% or so, above the top of the big M and then reverses. Often a strong move down follows. It's like traders push up the stock to hit stop-loss orders placed by the shorts, and once they are out of their positions, they drive price lower, cleaning the table. What I'm describing is an example of a double-busted big M. Those are nasty for shorts unless they time it right. How do we play this scenario? Price closes above the top of the big M, busting the downward breakout, and then reverses to head back down. That's the time to short. Finally, in a number of cases, I saw a large gap open as price climbed up to the big M during the BC rise. The top of those gaps supported price on the way down, so they make for a good price target. Table 6.11 shows information that I mentioned previously, but decided to put in a table for your viewing pleasure. Higher peak performance. I looked at performance based on which peak of the big M was above the other, or even. In bull markets, a higher right peak suggests better performance. I would have guessed that a lower right peak would suggest a weak situation, but maybe a higher peak means there's farther to drop. Time to drop. I measured the median time to rise from the launch price to the first peak compared to the drop from the right peak to the ultimate low. The time is about 2 to 1, so you can measure the time from the move up to the first peak, double it, and that will give you an estimate of how long you'll need to remain in the trade to reach the ultimate low. My guess is it won't be that easy, but at least you'll have an estimate. Sample trade. Justin is an experienced trader, and he's shorted enough stocks to become proficient at it. I got interested right there. In Figure 6.4, he pointed to the strong drop the day after peak E and made plans to trade the big M, the twin peaks at C and E. Price started a concerted effort to climb when it broke out of a congestion region at B. Price paused at H and moved sideways for a time when it hit overhead resistance, set up by the sideways move from August to November 2017, shown by a horizontal line connecting circle H. He checked a wider view of the chart to see where support and resistance were located. The daily chart showed a ceiling of overhead resistance blocking an advance higher, line A. Price at the top of the big M, peaks C and E, smacked against that resistance and ducked. I checked the weekly chart going back to 2015, but didn't see much support between D and H. But look at H. It's tight with lots of overlap as price moves sideways. Very nice. A loose-looking congestion region has price meandering all over the place, but H looked different. H is my target. I think the stock will drop that far. What about the knotted I? I asked and circled it on the chart. It'll support price. It's an energy barrier. When Chakotay and 7 hit 1, they crashed. You don't want that to happen. He made a funny face. It's from Star Trek Voyager. I like football, baseball, and soccer, any sport with a ball. I wondered how he felt about polo, but decided not to ask. I pointed to I again. It's too close to the breakout. The stock will blow right through that without pausing and head down to H. Trust me, I do this for a living. I know what I'm talking about. My face didn't move a muscle, but inside I grinned and thought that his money was about to become someone else's. He used the measure rule to determine how likely it would be for price to reach H. The top of the pattern is at C, 24, and the bottom is at D, 20.60, for a height of 3.40. The top of the region at H is at 1450, or 1.75 times the height of the big M below the bottom of it. From table 6.10, he calculated a 48% chance of reaching point H by interpolating the numbers of 55%, 0.55 of patterns reaching the target using the full height, and 26%, 0.26 of them using the 2kex height. That is 0.26 plus 0.55, 0.26 times 0.75 equals 48% chance of the stock dropping to H. The 0.75 number is 75% of the distance from 1 to 2, which is where H 1.75 times the height sits. How did he feel about a 48% chance of success? He looked at me and cocked an eyebrow. Yuck, he said. For grins, he computed the height of the big M, 3.40, and divided it by the breakout price, 20.60, to get a value of 16.5%. According to table 6.5, the pattern was tall, making him feel better. He considered B to be the launch price, and table 6.10 said there was a 52% chance of reaching it, the last line in the table. The two values were different, a 48% chance of reaching H and a 52% chance of reaching B, which was further away. Maybe a subspace anomaly would be involved. I didn't say anything to Justin because a ball wasn't involved. He had an order to short the stock if it dropped a penny below the low at D, or 20.59. He placed an order to cover the short at 17.3, his target, above the top of the region at H and above round number support at 17. Once the short triggered to open the trade, he placed a stop to exit the trade should price rise a penny above C, or 24.01. Then he sat back and watched disaster unfold. The stock broke out downward at F, placing him in the trade, and it hit the energy barrier at the price of I. As I left his house, I started whistling the Voyager theme song. The stop covered his position at G for a loss of 3.42 a share, not including commissions. What did Justin do wrong? I think he should have anticipated a pullback at the energy barrier, the not at the price of I. After that, though, I would have expected the stock to resume the downward move to H. Table 6.4 says that 60% of the time, price does resume the downward move. Fortunately, he had a stop in place to protect his backside while he waited for the Voyager crew to rescue him. End of Chapter 6. Chapter 7. Big W. Results snapshot. Appearance. Price forms twin bottoms at or near the same price with an unusually tall left side, often looking like a big W. Upward breakouts. A big W is nothing more than a double bottom with a tall left side. It might have a tall right side too, but that depends on how well the stock performs after an upward breakout. If price doesn't break out upward, then it's not a big W. I'll discuss identification guidelines later. The above results snapshot shows important performance numbers for the big W. For example, the break-even failure rate at 9% is quite good, meaning relatively small compared to other chart pattern types. The average rise for perfect trades is 46%, bull market, which is also good, hence the rank of 11 where 1 is best. Bear markets see price climb by 30%, which ranks 8 out of 20, where 1 is best. If you use the full height of the pattern in the measure rule computation, price will reach the target 55% to 74% of the time, bear, bull markets, respectively. Let's look at examples of big Ws. Tour, figure 7.1, shows what a big W looks like. The pattern has the first bottom at B, the second one at D, with a hill in between, C. The pattern confirms is valid when price closes above the top of the hill. The left side of the pattern begins at A, which is what I call the launch price. The stock drops in a straight line run down to the first bottom of the big W. After the big W forms the second bottom, price recovers. In this example, the stock rises to E in a quick sprint higher from the low at D. That's still well short of the launch price, A. After point E, the stock is like a speedboat pulling a water skier. You get a lot of thrust to get the skier on top of the water, to E, and then the boat planes out, on the way to F. It's possible that the stock will recover and post a new ultimate high, so F is tentative until more data arrives. Volume G has a U-shape in this example until the spike at D. Linear regression says volume trends upward from bottom to bottom, so that's why I drew the line sloping higher at G. Volume for the big W trends downward most often, though. Identification guidelines. Table 7.1 shows identification guidelines for the big W and refer to figure 7.2 for guidance. Appearance. The big W is a form of double bottom, one with a tall left side, and if the pattern works as it's supposed to, a tall right side as well. The two valleys should bottom near the same price. Use your best judgment as to how close the bottoms need to be to each other. Often, the bottom-to-bottom variation is small. The median is 14 cents. Price trend. The downtrend from A to B is a steep drop like that shown in the figure. You want to avoid patterns that see price meander or even move sideways as the drop approaches B. If price takes its time reaching the first bottom, then the chart pattern is probably a double bottom. See one of the Adam and Eve varieties. Eyeball the height from the center peak between the two bottoms to the lower of the two bottoms. Then make sure the left side of the pattern is at least that height above the central peak. For example, the height of the big W is the high price at point C minus the low at B. The left side must be at least this height above C. In this case, the downtrend begins at A, which is well above C, so the downtrend from A to B is tall enough. A tall left side is what separates big W's from double bottoms. A big W is a type of double bottom, but few double bottoms are big W's. I hope that makes sense. Volume. Don't disqualify a big W because of its volume trend. However, most of the time, you'll see volume trending lower from Valley B to D. Linear regression on the big W shown in the figure says volume slopes upward. It doesn't look like it does, but the numbers say otherwise. I show the upward trend at H. Breakout direction, confirmation. Price always breaks outward from a big W. If it doesn't, then you don't have a big W. A breakout occurs when price closes above the hill between the two bottoms. In figure 7.2, that would be a close above C, which I show as a horizontal line at E. Price confirms the big W as a valid chart pattern when it closes above C. Again, if you don't have confirmation, then you don't have a big W. Duration. I did not set a minimum or maximum width between the two valleys. They ranged from a very narrow 4 days to 260 days. I looked at the 4-day pattern, and it looks fine. Focus on failures. Figure 7.3 shows what the failure of a big W to perform looks like. The big W is at ACB, with A and B being the bottoms, and C being the hill between the bottoms. Price drops from H in a long and steep move to the first bottom. The stock confirms the pattern as valid at D, where it closes above the horizontal line drawn from the high at C. Price spikes higher at E, but closes the trading day near the bottom of the price bar, at F. That close is below the lower of the two bottoms, A. The breakout from this big W was upward at D, but price reversed and closed below the bottom of the big W, busting the upward breakout. Volume G, in this example, slopes upward from A to B. Table 7.6 says that volume slopes downward 69% of the time on average, and yet all three figures shown so far have upward volume. Why did this big W fail to rise back to the launch price, H, the point where the long downtrend leading to point A began? We can only speculate as to the answer. I checked the internet for news at price bar EF and found that the company released second quarter earnings before the market opened. Apparently, the stockholders couldn't make up their minds about the news. Sometime during the day, price climbed up to E, perhaps on news that the company settled a patent dispute. Once price dropped below bottom B, it may have triggered stops, helping price decline to F. In this case, it appears the earnings announcement prevented the big W from fulfilling its promise of rising to H. Statistics. Table 7.2 shows general statistics for the big W pattern. Number found. Most of the patterns I found manually over the years, but automated finding them to highlight big W's I might have missed, like the one shown in figure 7.3. I checked each one to be sure it was a proper pattern. I uncovered almost 2,700 patterns in 765 stocks using data from July 1991 to September 2019. Not all stocks covered the entire period, and some no longer trade. Reversal, continuation C, occurrence? The big W is a reversal pattern. Price enters the pattern from the top, going down, and exits out the top, going up, reversing the inbound downtrend by definition. Average rise. The average rise is decent in bull markets, with gains averaging 46%. That's if you trade it perfectly, over 2,000 times. Your trades may do better or worse than what's shown in the table. As you would expect, bear markets with upward breakouts see price climb less far than in bull markets. Standard & Poor's 500 change. I measured performance of the S&P 500 index from the date of the big W's breakout to the ultimate high. The table shows the result, which is inferior to the big W's performance. I'm not sure if the comparison is fair. It might be like comparing the times of two marathon runners, one who is top-ranked and the other who is an amateur. The top-ranked runner will have a better time than one who walks the 26 miles. Days to ultimate high. To gain 46%, it takes time, about 7 months in bull markets. Bear markets see gains taking less time, about 3 months, but that's because the average rise is less, 30%. However, a check of the numbers says the velocity in bear markets is higher than in bull markets, even when a rising price trend is heading against the current in bear markets. The bear market velocity is almost twice as fast as in bull markets. It might be because of the lack of a posted speed limit. How many change trend? I counted how many big W's saw price rise more than 20% after the breakout. And I must say, the bull market posts a terrific number, ranking 6th and 8th for bull and bear markets, respectively. Big MS in bear markets show good performance too, but not as good as in bull markets. That's expected, of course. A rising tide lifts all boats in bull markets, but bear markets depress performance after upward breakouts. Table 7.3 shows cumulative failure rates for big W's. The break-even failure rate is 9%. That means 9% of the big W's fail to see price rise more than 5% after the breakout. Look at how the failure rates climb. In bull markets, 20% fail to see price rise more than 10%. Want to make 50% on your trades? You'll lose 73% of the time in bull markets. That's 1 winner and 3 losers, and that's if you trade it perfectly. In bear markets, the results are even worse, with 84% failing to climb more than 50%. Set realistic goals and realize that you'll have to make more on winning trades to compensate for losing ones. Trading perfectly also helps. That's a joke. But focusing on improving technique often leads to making more profit. Table 7.4 shows breakout and post-breakout statistics. Breakout direction. All big W's break out upward. If they don't, then they are not big W's. Yearly position, performance. I sorted patterns according to the breakout price and checked performance of the 3 ranges. The best performance for both bull and bear markets comes from big W's near the yearly low. The worst performance comes from those near the yearly high. It suggests that bottom fishing, buy low, sell high, works better for big W's than momentum trading, buy high, sell higher. Throwbacks. A throwback happens after the breakout when price rises but quickly returns to the breakout price within 30 days. Often price resumes the rise thereafter. In figure 7.1, for example, the throwback peaks at E before returning to the breakout price. Figure 7.2 shows a throwback after point E. Throwbacks occur about twice every 3 trades. Price peaks in 6 days after rising between 8% and 11% on average, before completing the trip back to the breakout price, or nearly so, in 12 days. That's the round-trip total. Notice that price does better if a throwback is absent. We've seen this behavior in other chart patterns too. How can you tell if a throwback will happen? Look for nearby overhead resistance, such as prior peaks, round numbers, 10, 20, 30, and so on, or sideways price movement between the breakout price and about 10% higher. If you see some, then expect a throwback. In my trading, I always expect a throwback will happen, and I party when they don't. The vast majority of the time, between 60% bear market and 76% bull market, price will resume the upward move after a throwback completes. Few things are more aggravating than placing a buy stop a penny above the breakout price, getting into the trade perfectly, only to see a throwback take price lower. Sometimes, the stock continues down below the bottom of the pattern, and you're stopped out. Then you sit on the sidelines as the stock recovers and soars like an eagle. Fortunately, this type of behavior is rare for big W's. Table 7.9 says it happens 20% or less. You can always wait for a throwback to complete before making a trade. However, if you wait, you'll miss investment opportunities where a throwback doesn't occur. That is, you'll miss the best performers. Gaps. Breakout day gaps push price higher, meaning performance is better if a gap appears. However, in bull markets, the extra push probably won't be enough to wake you from a sound sleep. In bear markets, it's more of a jolt. How can you tell if price will gap higher? I've no idea. However, I measured performance from the opening price the day after the gap to the ultimate high. So if you see a gap, you can buy into the situation and maybe score extra performance points for doing so. Table 7.5 shows how the sizes of big W's perform. Height. Tall big W's perform better than do short ones. To use this finding, measure the height of the big W from the peak between the two bottoms to the lower of the two bottoms. Divide the result by the breakout price, the price of the peak between the two bottoms. If the result is bigger than that shown in the table, then you have a tall pattern. Width. Bear markets don't see a performance difference, but in bull markets, wide patterns perform slightly better than narrow ones. The median width between narrow and wide is about 3 weeks. See the table. The width is the time between the two bottoms. Height and width combinations. Patterns that are tall and wide outperform the other combinations of height and width. You might want to avoid short patterns, either narrow or wide. They underperform in bull markets and don't do that well in bear markets. Table 7.6 shows volume statistics for the big W pattern. Volume trend. Volume trends downward most of the time, as measured using linear regression between and including the two bottoms of the big W. As I mentioned, don't discard a big W because it has an unusual volume trend. Remember, the trend is your friend. Rising, falling volume. Patterns with falling volume, as measured from bottom to bottom in the big W, perform best in both bull and bear markets. The bear market shows the biggest difference between the two values, 31% versus 25%. The 25% number comes from 136 samples, so additional samples will likely narrow the gap. Breakout day volume. Bull markets don't see a performance difference, but bear markets do, with heavy breakout volume helping performance. The difference seems unusually wide, though, so additional samples will likely narrow the spread. Table 7.7 is one of my favorite tables because this kind of trading information can pay for the price of this book. How often are stops hit? I placed a stop-loss order at the peak between the two bottoms, and price touched this. After the breakout and on the way to the ultimate high, over 70% of the time. Scoot the stop a bit lower, the middle of the big W, measured from the peak to the lowest valley, and the stop triggers less often, between 13% and 20% of the time. Place it at the lower of the two bottoms, and it'll hardly trigger at all. The safe place to locate a stop-loss order is below the bottom of the big W, but the distance between the stop and the buy price may entail a large potential loss. The rumors are true. Positioning a stop is an art you need to master to become a successful trader. Once you decide where to place the stop, convert the potential loss into a percentage of the current price. If you gasp at the result, then the stop is too far below the current price. Either adjust the stop location, abandon the trade altogether, or hope the trade succeeds. Table 7.8 shows how big W performance has changed over 3 decades. Because bear markets only occurred in the 2000s, they were excluded from consideration. Performance over time. The 2000s were the outstanding decade for performance, with gains averaging 51%. The worst performance came in the 1990s, with the 2010s nestled comfortably between those two. Failures over time. I would expect to see low failure rates in the 2000s because that was the best performing decade, and yet the table shows it's tied at 8% with the 1990s. The 2010s showed a slight uptick in failures. The failures I'm reporting on, by the way, are 5% failures. They count how many big W's fail to see price rise more than 5% after the breakout. Table 7.9 shows statistics related to busted patterns. Busted patterns count. Big W's rarely bust, as the table shows, compared to other patterns which see busts in the 40% range. What does this mean? Up to 20% of the time, on average, price will fail to rise more than 10% after the breakout before reversing and closing below the bottom of the big W. So if you want to make a lot of money, then 1 in 5 trades won't exceed 10% profit on average. And that's if you trade it perfectly. Busted occurrence. For those patterns that busted, I sorted them into one of 3 bins: single, double, and 3 or more busts, triple plus. The table shows single busts happening most often, followed by double and triple busts. In some other pattern types, we see triple busts coming in second place, so big W's behave themselves. Busted and non-busted performance. Compare the performance for all busted patterns, drops of 15% in bull markets, with the performance of big MS, not W's. Big MS see price drop an average of 17% after a downward breakout, and they act as the proxy for a non-busted big W. Busted pattern performance for big W's is not as good as trading a big M chart pattern. However, if you are lucky enough to trade a single busted big W, then price drops an average of 23% in bull markets. That's exceptional for a bearish pattern. Of course, your mileage may vary. How can you tell if the big W will single bust as opposed to double or triple bust? I'll leave that as an exercise for the reader. Translation: I have no idea, but focus on nearby overhead resistance that might turn price down or the timing of an earnings announcement. Trading tactics. Table 7.10 shows trading tactics. Measure rule, targets. Use the measure rule to help determine how far price may rise after the breakout. The lower portion of the table shows the numbers. Before I get there, let me explain how to use the measure rule. Measure the height of the big W by subtracting the lower price of the two bottoms from the price of the highest peak between the two bottoms. Add the height to the peak between the two bottoms to get a full height target. The table says that price will reach that target 74% of the time in bull markets. If you use different multiples of the height, half, 2 times, or 3 times, you will see different hit rates. For example, if you like to hold on to a stock and target 3 times the height, compute the height as already described, multiply it by 3, and add it to the breakout price. Price will reach the target 39% in bull markets, but only 17% in bear markets. Stop location. Use Table 7.7 to help determine where to place a stop. You can use a volatility stop, which is based on how volatile a stock is, to locate your stop. Often I'll stick a stop below a nearby minor low and double check that with a volatility stop. See the glossary for details on volatility stops. Return to launch price. Look back at figure 7.1. Point A is the launch price. It's the price where the stock begins the decline in earnest, leading down to the big W. Unfortunately, the launch price can be hard to determine in some cases, so I use the measure rule to give better targeting guidance. However, the stock can return to the launch price after a big W breaks out. Keep that in mind when setting targets. Look for price to stall just short of the launch price. Figure 7.2 shows an example of that. The launch price is point A, and price climbs to F, which is just below the price of A. The last line in the table shows the stock returns to the launch price 70% of the time, on average, in bull markets. To use this finding, convert into a percentage the distance from the current price to the launch price. If it's a high percentage, then it'll probably be unrealistic. You can run the potential gain by Table 7.3. For example, if the current price is 40 and the launch price is 50, that means a gain of 25%, or 50 if yours 40 or 40 times 100. Table 7.3 says that almost half, 46%, will fail to see price rise more than 25%. Table 7.11 shows features that might improve trading a big W, lower valley performance. I checked the performance of big Ws, where the price of the left bottom was above, below, or equal to the right bottom. There wasn't much of a performance difference except for big Ws, where the price of both bottoms was the same. When that happened, performance suffered, and quite substantially. Higher bottom volume. I found that if the right bottom of the big W has volume higher than the left bottom, patterns outperform in bull markets and underperform in bear markets. Because the bull and bear market values show opposite performance results, it concerns me that this finding won't be reliable. Use it with caution. Time to launch. I measured the time from the launch price to the first bottom and compared it to the time from the second bottom to the ultimate high. The numbers show that the drop into the big W is short, about 3 weeks, but the recovery is long. In bull markets, the median is about 4 times as long. Rise between valleys. I compared the height of the peak between the two bottoms of the big W to performance. If the rise was taller than the median, measured as the height from the peak between the two bottoms to the lower of the two bottoms divided by the price of the lower of the two bottoms, then performance improved. In bull markets, the differences are pronounced compared to bear markets. Experience. I have traded the big W a number of times, but all from the buy side, so the lessons learned aren't as important as those on the sell side. To put it another way, it doesn't matter at what price you buy. It only matters at what price you sell. Let me tell you about what I found in my trade review. Abercrombie & Fitch Co. Abercrombie & Fitch Co., ANF, in 2017 had been trending lower for almost a year after peaking in March 2016. I saw a big W forming and thought this would make for a good bottom fishing trade. Here's what I wrote in my trading notebook. Buy reason. Extra cash. I'm hoping that this will be the start of a rebound, a fallen angel type play. Earnings were good and the stock shot up and then threw back, as expected. It should recover from here, based on a good earnings surprise. If not, then sell when it gets in the 10+ range to keep the dollar loss small. The odds don't favor this trade, but I'm betting the stock has bottomed and will recover from here. The earnings announcement saw price climb from 11.69 to a high of 13.75 the next day, or almost 18%, but it retraced most of that gain by the time I bought on the 10th of March. I received a fill at 11.68. The position size was small, about 1/4 of what I normally trade, and that told me I was concerned about the stock. I sold the stock at 10.92 after the report of weak same-store sales numbers less than 2 weeks after I bought, taking a 7% loss. This was one of those trades where the smart money is just waiting to trap you. I sold the day price bottomed. The stock recovered, but only to 12.46 before dropping again. The stock bobbed up and down, eventually making another big W in August and September 2017, which was the real bottom. From there, the stock climbed from its confirmation price of 10.49 to peak at 29.20, or 178% higher. My instincts were good. I picked a stock that almost tripled, except the timing was wrong. I missed entering a winning trade by 6 months. I made a perfect entry, buying after a throwback completed, and sold on the day price dropped but didn't close below the bottom of the big W. If I had waited for price to close below the bottom of the big W, I would have stayed in the trade longer, but would have taken a slightly bigger loss. The big question comes from a curious mention in my notebook. The odds don't favor this trade. Lesson: if the odds don't favor the trade, then don't make it. Lesson: keep the position size small if you believe a trade is risky. Teradyne Inc. I made a trade in Teradyne Inc. as the stock emerged from the 2007 to 2009 bear market. A big W confirmed, and I bought in at 5.94 on the 1st May 2009. The stock threw back, but then cooperated and climbed. Later in the year, it moved sideways until August 2010, when it resumed its upward move. Here's what I wrote in my notebook. Sell reason. Hit stop. This sold on reaction to market weakness, so my guess is I sold too soon. I expect a rebound, but you can't be too sure. I sold within a week of the stock peaking and before it dove by more than 40%. I made 194% on the trade. I almost tripled my money. This is one of those trades you want to climb up on the roof of your house with a megaphone and shout at your neighbors that you're rich. Of course, you'd be gunned down by the rednecks surrounding your house like a moat, so don't do that. There is no lesson to share with this trade. A perfect entry and perfect exit led to a nice reward for holding on to the stock for 1.8 years. Ann Taylor. In Ann Taylor, the stock made a big dive, forming the left side of the big W in late 2006. I bought on 1st February 2007 at a price of 35.19. This was a late entry by about 2 weeks, and yet if I had bought at a penny above the confirmation price, I would have entered the trade at a lower price, 33.82. My preferred entry method is to place a buy stop a penny above the breakout price. On the sale, here's what I wrote. 21st March 2007. I decided to sell this using a trailing stop set between today's close and the low plus 0.001 as the sense margin, 11ths. I think this has to do with setting an automated trailing stop with my broker. Hopefully, this will move up in the morning and I can get out at a higher price than just selling at the open. The market was up big today, and this stock was one of the few to close lower. It's running up against SAR, support and resistance, at 39 to 40, as predicted. My guess is it'll form a handle and backtrack. I don't want to wait around, though. I think the company sucks because SSS same-store sales are soft despite positive comments from the company. I received a fill at 39.09. 4 trading days later, the stock peaked at 39.92 before entering the bear market and seeing the stock bottom at 2.41 or 94% below where I sold. I made 11% on the trade. Lesson: buying as soon as the stock breaks out of a chart pattern is often better than waiting. Energy East Corp. With Energy East Corp, EAS, I saw a big W forming, and price didn't confirm the pattern before heading back down to the price of the first bottom, where I bought. I received a fill at 23.12. The stock cooperated for a time by rising but eased lower and looked to be heading down about 3 weeks after I bought. I sold it for a 2% loss so I could deduct it on my taxes. From my notebook, sell reason, end of year tax loss selling. This is going down, I predict, so it's time to dump it and lower my cap gains taxes. This H&S Head & Shoulders bottom didn't work as expected. The Head & Shoulders became apparent after I bought, which happened at the right shoulder low. and it never confirmed by the time I sold on 30th December 2005 at 22.69. This trade contradicts the prior lesson. If I had placed a buy stop a penny above the top of the big W, I would have entered the trade at 24.06, well above my 23.12 purchase price. The big W didn't confirm until 10th January 2006, where the stock continued up to make a vertical run for 8 days, peaking at 25.57. Then it moved sideways to down for 1.5 years. I sold on the day the stock started to climb in that vertical rise. Bad exiting timing, that's for sure. But I would have collected dividends from the electric utility only if I had continued to hold the stock, so selling was a good choice. Sara Lee Corp. Sara Lee Corp, SLE, in September 2008 was another buy into a big W that didn't confirm. I lost 4% on that trade when the stock hit my stop and continued lower in the 2007-2009 bear market. Lesson: if premature breakouts are a concern, wait for confirmation before entering a trade. Swift Transportation Co. In Swift Transportation Co., SWFT, I played the big W differently. I bought when price returned to the launch price, expecting a strong move higher as oil prices were trending downward. Sell reason: the stock has made a large down move today, following the market lower, and others in the industry are down. I believe this will move lower, forming a handle to the big W. A handle did form, and I sold in the early part of that development at 1925 for a loss of 8%. I watched from the sidelines as price climbed to 33.66. I missed out on a potential gain of 75%. Sigh. Again, I picked the right stock, but it took me out when it formed a handle before making a strong push higher. I don't have a lesson to share except the idea of riding price higher after it reaches the launch price might have merit. Test it to be sure it can work for you and your markets. Sample trade, figure 7.4 shows this chapter's sample trade with the big W located at AC. Before I discuss the trade, let's apply the measure rule to this pattern. The measure rule uses the height of the big W. The peak B between the two bottoms has a high price of 12.66. The lower of the two bottoms is C at 11.27 for a height of 12.66, 11.27, or 1.39. Add the height to the price at the peak C, and you get a target of 12.66 plus 1.39, or 14.05. Price will reach the target 74% of the time in bull markets, according to table 7.10. If you want a closer target, take half the height and use that. Thus, a closer target becomes 12.66 plus 1.39 use, or 13.36. Price reaches the half-height target 88% of the time. Want to know if the big W is tall? Take the height, 1.39, and divide it by the breakout price, 12.66, to get 1.39, or 12.66 times 100, or 11.0%. Table 7.5 says that a tall pattern needs to have a value above the median 11.9%, so this pattern is short. That suggests underperformance. The launch price is at H, where the downtrend begins. H could be a post-breakout target, but as you can see, the stock didn't climb that far. Volume trends downward, G. So that's good for performance from table 7.6. It may be difficult to tell from the chart, but the left bottom has volume of 492 shares and the right bottom has volume of 791. In other words, the right has higher volume, and that's good for performance from tables 7.10 and 7.11. The pattern is short, bad. Volume trends downward, good, and the right bottom has higher volume than the left, good. This seems to suggest a better performing big W. Of the three measures, the height is the most important, and it was bad. That's not a good omen. How did John trade the stock? I didn't. Why not? I used your simulator to scan charts and didn't like what I saw. I looked for a horizontal move followed by a big W. He was referring to my pattern software, available for free on my website at www.thepatternSite.com, which has a trading simulator built into it. It will advance to a chart pattern and then play back price at the speed of your choice. I saw setup after setup which didn't work, so I decided not to trade the stock. Sometimes the best trade you can make is none at all. However, another setup is similar to this situation. Imagine the same setup with price forming a top, moving sideways, D, and dropping to a chart pattern, a big W or other type of chart pattern. Price does its thing, and the stock eventually climbs to close above H, the high point in the horizontal D move. That's the time to buy. I described this setup at /thepatternSite.com/cpsetup.ml. Note, case is important. In figure 7.4, price broke out upward from the big W, a close above B, the day before E. That confirmed the big W as a valid chart pattern. Then price stalled as if the bulls were afraid of attacking overhead resistance set up by the sideways move at D. The stock collapsed, and when price closed below the bottom of the big W at F, it busted the upward breakout. The stock recovered to poke its head above 13, but moved lower to bottom at 8.11 in December. Had John bought at the breakout price and sold at the ultimate low, he would have lost 36%, not including commissions and fees. He made the right decision to walk away from this trade. End of Chapter 7. Chapter 8. Broadening Bottoms. Results. Snapshots. Price trends downward, leading to the chart pattern. The pattern looks like a megaphone with higher highs and lower lows that widen over time. Upward breakouts. Reversal or continuation. Long-term bullish reversal. Performance rank, 15 out of 39. Break-even failure rate, 16%. Average rise, 45%. Volume trend, upward, throwbacks, 69%. Percentage meeting price target, 65%. Synonyms, broadening triangle, 5-point reversal. See also, broadening tops. Downward breakouts, reversal or continuation. Short-term bearish continuation. Performance rank, 23 out of 36. Break-even failure rate, 26%. Average drop, 15%. Volume trend, up pullbacks, 62%. Percentage meeting price target, 41%. Broadening bottoms are middle-of-the-road performers because the break-even failure rate and average rise or decline are mediocre. I've traded this pattern only a handful of times over the years, but made a profit 75% of the time. Even though performance needs improvement, maybe you can make money trading the pattern. Let's see what broadening bottoms have to offer. Tour. Figure 8.1 shows an example of a broadening bottom. This particular one is called a 5-point reversal because there are 5 alternating touches, 2 minor lows, 2 and 4, and 3 minor highs, 1, 2, and 3. A 5-point reversal is also rare. In one study, I located only 5 in the 77 broadening bottoms I examined. Price trends downward in late August and reaches a low 2 days before the chart pattern begins. That brief dip is what I call undershoot, where the stock is so excited as it drops, it dips below the beginning of the chart pattern within 2 weeks of its start. I ignore brief dips and overshoot, a brief rise within 2 weeks of the pattern's start, when determining the trend start. See the glossary for details, leading to a chart pattern. Price overshooting or undershooting the formation start is common in many chart pattern types. How does a broadening bottom differ from a broadening top? A broadening bottom has price trending downward into the start of the pattern. A broadening top has price trending up. The difference is arbitrary. I made the distinction thinking that the two might behave differently. If you ignore undershoot in this case, the broadening bottom appears at the bottom of the downtrend. Hence, the pattern is a broadening bottom and not a top. This particular chart pattern shows a partial decline, which correctly predicts an upward and immediate breakout. Price moves down from 26 to 24.50, reverses course, and shoots out the top. The stock reached a high of 38.50 just over a year later. Identification guidelines. Table 8.1 lists identification guidelines for broadening bottoms. Appearance. The shape of the broadening bottom reminds me of chaos theory, where small disturbances oscillate back and forth, then grow unbounded, wreaking havoc. In the stock market, price begins to bounce between 2 imaginary barriers that diverge, forming a megaphone shape. When you draw a trend line touching the minor highs along the top and another connecting the minor lows along the bottom, the broadening pattern becomes apparent. Neither the top nor bottom trend lines should be horizontal or near horizontal. Rather, price along the peaks becomes higher and price along the bottoms trends lower. Use the figures in this chapter for guidance. Price trend. Price trends downward into the start of a broadening bottom. Even if price rises a week or two before the chart pattern begins, overshoot, ignore it. The pattern is still a bottom. This arbitrary designation makes intuitive sense. A bottom should appear at the end of a downtrend, not when price is climbing to the moon, and not if price spiked upward just before the pattern started. Trend lines. 2 trend lines drawn across the minor highs and lows outline the pattern. The top trend line should slope up. The bottom one should slope down. The diverging trend lines distinguish the broadening bottom from other types of chart patterns, such as the right-angled broadening formation, which has 1 horizontal trend line, and the broadening wedge, Both trend lines slope in the same direction. Touches. To prevent confusion, I changed the guidelines to require at least 5 touches, 3 of one trend line and 2 of the other. Fewer touches increase the likelihood of misidentification, but it still might be a broadening bottom. Play it safe and look for at least 5 trendline touches. Each trendline touch should be at or near a minor high, top trend line, or minor low, bottom trend line. What is a minor high or low? A minor high happens when price trends up, then drops back down, leaving a clearly defined peak. A minor low is just the same except flipped upside down. Price moves lower and then heads back up, leaving a clearly defined valley. In Figure 8.1, odd numbers tag the minor highs and the even numbers are the minor lows. Let me stress that the minor highs and lows need not be alternating, as shown in the figure. Just as long as you can count at least 5 touches, then that's fine. If price cuts through a trend line, then don't count that as a touch. Notice that at the start of this pattern, on the bottom, price cuts through the lower trend line, but it doesn't count as a touch. White space. Figure 8.2 shows a problem with identification. This is from 3M, MMM, in August 2019. On the left side, bad, the stock appears to make a broadening bottom. It has 2 touches of the top trend line and 3 on the bottom, as required. The problem is that white hole in the pattern, which I highlighted A. Price does not cross the pattern enough to fill the space. Compare the left side with the right side, better. It's the same picture, except I show a down-sloping channel. It's not perfect because of the spike at B, but it'll do. This is a better interpretation of a viable chart pattern compared to the left side. Do not cut off a turn like I've shown on the left side and call it a broadening bottom. Volume. There is nothing magical or important about volume. I used linear regression from the start of the chart pattern to its end and found that volume trends upward most of the time in this chart pattern. Breakout direction. The breakout price can be difficult to identify in a broadening chart pattern as the pattern develops. I look for the place where price pierces the up or down trend line or makes an extended move, hugging the trend line. If price closes outside a trend line boundary, then the penetration point becomes the breakout price. If price moves up, for example, and follows along the top trend line without piercing it, then I backtrack to the prior minor high and draw a horizontal line forward in time until price closes above the horizontal line. When that happens, that is the breakout point, providing the pattern obeys the other identification guidelines first. Use the same logic for a downward breakout. Let me give you an example. Consider the broadening bottom shown in Figure 8.3. Where's the breakout from the broadening bottom? If you wait for price to close above the top trend line, then you'd have to wait until C. Imagine if the top trend line were steeper. You might never see a breakout. If the pattern meets all of the identification guidelines, especially trendline touches, and price begins sliding upward along the top trend line or downward along the bottom one, like you see from B to D, then go back to the prior minor high, upward breakout, or prior minor low, downward breakout, and use that price as the breakout price. In this case, point B is the prior minor high in the chart pattern, and the breakout is point D. If you worry about buying into the broadening bottom too late, then skip the trade. Chart patterns are not like attending a party 15 minutes late. Promptness pays. Focus on failures. Figure 8.4 shows a typical broadening bottom failure. Price trended down from the March high. On the 19th of March, the company announced the pricing of a secondary public offering of nearly 8 million shares of common stock. The stock price took a hit and shares tumbled that day and the next, just before the start of the broadening bottom. The broadening bottom formed innocently enough, with price swinging from low to high, A. Price touched the top trend line 3 times and the bottom trend line 3 times, as one would expect in a well-behaved broadening bottom, meaning at least 5 touches. At B, the stock broke out downward from the broadening pattern when price closed below the lower trend line. Because price trended downward going into the pattern, a trader might expect a downward breakout too, so the pattern acted as a continuation of the downward price trend. Indeed, they might expect price to drop back to just above the December 2018 low, F. However, the stock surprised traders when it stalled at C. It was even more of a shock when the stock began to stair-step higher and closed above the top of the pattern at D. At D, the stock busted the downward breakout. After that, The stock was an airline taking off and flying into the clouds. The behavior of the broadening pattern shown in the figure represents what I call a 5% failure. Price breaks out lower, but fails to continue moving in the breakout direction by more than 5% before heading back up. The reverse is also true for upward 5% failures. Price climbs after an upward breakout by no more than 5% before tumbling. Statistics. Table 8.2 shows general statistics for the broadening bottom chart pattern. Number found. I dug up 1,238 patterns in 667 stocks, starting from August 1991 to September 2019, but removed the bear market ones because they were too few when sorted by breakout direction. Not all stocks covered the entire range, and some no longer trade. Both up and down breakouts are for bull markets. Reversal R, continuation C, occurrence. By definition, a bottoming pattern has price entering the pattern from the top. A pattern acting as a reversal sends price out of the pattern upward, reversing the downtrend. A continuation pattern breaks out downward, continuing the downtrend. Average rise or decline. Price posts a 45% rise after an upward breakout, helped along by a bullish general market. Downward breakouts suffer when price tries to drop in a bullish market. That's like swimming against the current. Standard & Poor's 500 change. The performance of the index can't compare to the performance posted by the chart pattern. That's typical, but I'm not sure it's a fair comparison. We're comparing a perfect trade to the index, using the same dates as the broadening bottom trade. It does show that broadening bottoms can beat the indices, and it also shows that the general market helps performance. Days to ultimate high or low. This is a measure of how long price takes to reach the ultimate high or low after the breakout. For upward breakouts, it'll take about 8 months of worry to reach the ultimate high. Downward breakouts take about 6 weeks to drop 15%. Compare the ratio of 45% in 240 days to 15% in 80 days. We discover that price drops nearly twice as fast as it rises. That might be a hint for options traders. You might be able to reach your price target faster during a downtrend than an uptrend. How many change trend? Over half of broadening bottoms with upward breakouts see price rise more than 20% after the breakout, which is good. Downward breakouts suffer, with only 29% dropping more than 20%. The best patterns see price forming strong and lasting trends. Table 8.3 shows failure rates. How do you measure failure? It took a while before I was able to answer that. I measured the move from the breakout price to the ultimate high or low and sorted the results into bins. Then I counted how many entries I had in each bin. It's like sorting coins you found under the seat cushions into piles of dimes, nickels, and quarters, and then counting how many dimes you found and how many nickels, and so on. If the break-even cost of trading is 5%, then we see that 16% of the patterns with upward breakouts will fail to see price rise more than 5%. Downward breakouts are worse, with 26% of them failing to drop more than 5%. Notice how the failure rates climb. Almost half, 46% of downward breakouts see price drop no more than 10%. Ouch. What does this mean? Trading chart patterns and expecting a huge gain is unrealistic. Large gains happen, sure, but you might want to invest for the long term, buy and hold, or stick to swing trading and nibble off what you can. Keep your expectations realistic. Table 8.4 shows breakout-related statistics. Breakout direction. This just in. Broadening bottoms break out upward more often than downward. Yearly position, performance. I sorted the breakout price into one of 3 bins, depending on where it was in the yearly high-low price range. The best performance came when the breakout price was near the yearly low. The worst was when it was near the yearly high. That suggests bottom fishing. Buy low, sell high. Works better for the broadening bottoms than momentum trading. Buy high, sell higher. Throwbacks and pullbacks. The next several rows in the table dissect throwbacks and pullbacks. If you don't know what a throwback or pullback is, ask your mom or check the glossary. Throwbacks happen 69% of the time. Price breaks out upward from a broadening bottom, rises for a week by an average of 6%, and then returns to or comes close to the breakout price by day 12. If you're an experienced swing trader, you might want to short a downward breakout and close the position in a week or when price drops 7%. However, the median decline is just 5%, so it might not be worth it. Anyway, I compared the performance of broadening bottoms with and without throwbacks or pullbacks, and found that the pattern performs better without a throwback or pullback happening. That's not a surprise because I've seen that behavior in other chart patterns too. After a throwback or pullback ends, the stock resumes moving upward 75% of the time after an upward breakout and drops 49% of the time after a downward breakout. Be careful when thinking you can short after a pullback completes. Price might continue rising instead, 51% do. Gaps. Do breakout day gaps help performance? Sometimes. Gaps are not a big indicator of future performance. I check the statistics for various types of chart patterns, double bottoms, head and shoulders, and so on, and the average performance improvement is 1 percentage point. Upward breakouts in bull markets saw price climb by 2 percentage points if they had a gap. That's for all non-Fibonacci chart patterns. In other words, there's not a big performance difference when you average all the numbers together. For broadening bottoms, gaps help performance by an average of 1 to 4 percentage points, depending on the breakout direction. The gap size is slightly larger after a downward breakout, and that might have something to do with how price drops faster than it rises. Table 8.5 shows pattern size statistics. This is one of my favorite tables because height is usually the best indicator of future performance. Height. Tall patterns outperform. What is meant by tall? Compute the height of the pattern from the top of the broadening pattern to the bottom and divide the result by the breakout price. A tall pattern will have a ratio larger than that shown in the table for the associated breakout direction. Warning, just because a pattern is tall does not mean it'll outperform. The numbers are an average of hundreds of perfect trades. Plus, you might flub the trade anyway. Width. Width is not as strong an indicator for future performance as is height. The table shows an example of this too. After an upward breakout, narrow patterns outperform, but wide ones do better after downward breakouts. To determine width, measure the calendar days from the start of the pattern to the end, and compare the result to the median width in the table. A value higher than the median means it's wide. Height and width combinations. According to the table for upward breakouts, if tall patterns outperform and narrow patterns outperform, you'd expect the combination of tall and narrow to be the best performer. Indeed, that's what happens, but that's not always the case. For downward breakouts, tall and wide patterns should outperform, but the results show that anything tall is best. Avoid short patterns. Table 8.6 shows volume-related statistics. If the height table is my favorite, then volume is at the other end. I think traders put too much emphasis on volume. Remember that for every share sold, one is bought. If an institution buys a gazillion shares, they are probably buying it from another institution that is selling a gazillion shares. Volume trend. Volume trends higher most often in the chart pattern. Rising, falling volume. I sorted performance by the trend direction and found that patterns with a rising volume trend outperform. Breakout day volume. Heavy breakout day volume only sees improved performance for broadening bottoms after upward breakouts. Table 8.7 shows how often price reaches a stop location. You can use this information to help locate a stop-loss order should you decide to use one. I'm not being cute here. Investors, buy and holders, should not use a stop in my opinion. Shorter-term traders would be wise to use a well-placed stop or a mental stop if you have the willpower to obey that. I sliced the chart pattern in half and measured how often price during a trade returned to touch the top, middle, or bottom of the chart pattern. See the glossary, stops. For details on how I did this in case you're interested. Hint, I didn't use power tools. If you place a stop at the top of the pattern, price will take out the stop 77% of the time after an upward breakout. Downward breakouts will only reach the top of the pattern 1% of the time. That makes sense, doesn't it? Table 8.8 shows the performance over 3 decades. How has the pattern performed over time? Let's find out. Performance over time. Upward breakouts in the 1990s suffered, but downward breakouts did better. I can't explain why. The 2000s contained not one, but 2 bear markets, but I excluded those results from the table. Failures over time. The 1990s were the worst performers, but they have the best, lowest failure rates. Again, this puzzles me. Because the failure rate is a function of performance, then I'd expected patterns that showed big moves to have lower failure rates. They don't. Table 8.9 shows busted pattern performance. At one time, I thought that busted patterns were the way to make a bundle trading chart patterns. They can be, but it's not as easy as you might expect. Busted patterns count. I counted the number of busted patterns and found that 42% of broadening bottoms with downward breakouts will bust. Ouch. It's less painful for upward breakouts, with a quarter of them busting. Busted occurrence. If we sort the busted patterns into 3 bins, single busts, double busts, and 3 or most busts, triple plus, we see the results in the table. Notice that most of the busts are single ones, busted and non-busted performance. The last 3 lines in the table show the performance of busted and non-busted ones. Notice that single busted patterns perform better than all busted patterns, single, double, triple plus, and also beat the non-busted pattern performance. Perhaps now you understand why trading busted patterns might be the way to riches. Probably not, but we can dream. Try looking for a single busted downward breakout from a broadening bottom. Then try to carve out a portion of the 46% average rise. Trading tactics. Table 8.10 shows trading tactics for broadening bottoms. Measure rule. The first tactic is to determine how much money you are likely to make in a trade. The measure rule helps with the prediction, but it's not a guarantee. To use the rule, compute the height by subtracting the highest high from the lowest low in the broadening bottom. Add the result to the highest high to get the target price for upward breakouts and subtract the height from the lowest low for downward breakouts. For downward breakouts, if the prediction says the stock will drop below 0, then ignore it. For both breakout directions, use common sense. A large gain or loss probably won't occur. The bottom portion of the table shows how well the measure rule works. Based on the full height, a stock will reach an upward target 65% of the time, but a downward target is harder to reach. It works just 41% of the time. You can change the height in the computation to assess how often price will reach a target. I provide a few possibilities, from half the height to 3 times. Let's use figure 8.5 to make the computation clear. Point A shows the highest high in the chart pattern at 14.13. The lowest low is point B at 12. The formation height is the difference between the two, or 2.13. Add the value to the high to arrive at the upward price target, or 16.26. For the downward target, subtract the height from the lowest low, that is 12 na 2.13 or 9.87. You can see in figure 8.5 that the price never quite reaches the downward price target. Go long at the low. Once you have uncovered a broadening bottom with the identification guidelines met, you can think about trading it as price crosses from side to side. When the price bounces off the lower trend line, buy the stock. Sell when price turns down. The downturn may occur as a partial rise partway across the chart pattern, or price may cross completely to the other side, touch the top trend line, and head down. Remember, the formation may stage an upward breakout, so don't sell too soon and cut your profit short. Long stop. In a rising price trend, place a stop-loss order 15 cents below a prior minor low. Should the stock reverse and head down, you will be taken out with a small loss. As the stock rises to the opposite side of the chart pattern, move your stop upward to 15 cents below the prior minor low. The minor low may act as support, so you will be giving the stock every opportunity to bounce off support before being cashed out. Go short at the high. The trading tactic for downward breakouts is the same. When price touches the top trend line and begins moving down, short the stock. Only advanced traders should attempt to short a stock. Short stop. Place a stop-loss order 15 cents above the highest high in the formation, then pray that price declines. Move stop. If luck is on your side and the stock heads down, move your stop lower. Use the prior minor high. Place the stop 15 cents above it. Partial rises, declines. If the stock makes a partial rise or decline, consider acting on it. The table shows how often they work. Partial declines work best. Take advantage of them when they appear, but make sure you place a stop-loss order in case the trade goes bad. Once price breaks out from the broadening pattern, consider selling if the price nears the measure rule target. This is most useful for short-term swing trades. There is no guarantee that the price will hit or exceed the target, so be ready to complete the trade, especially if there is resistance between the current price and the target. The stock may reach resistance and turn against you. Stop location. Table 8.7 shows how often price will reach one of three locations in the chart pattern. The results give you some indication of how risky a stop location may be. You may wish to consider using a volatility-based stop. See the glossary, volatility stop, for sliated, that's details spelled backward. Busted trade. Busted patterns, on average, outperform the non-busted counterparts. Table 8.9 discusses options for trading busted patterns. Experience. Let me tell you about what I found in my trade review. Southwest Airlines. Southwest Airlines, EV, hit turbulence in late 1999, going into the start of 2000. A broadening bottom formed. Here's my notes from my trading notebook. 25th of January 2000. I bought at market as the stock was moving up off the bottom of a broadening bottom chart pattern. At 15.3/8, not split adjusted, the stock is cheap and shows support at this level. Oil prices are high, meaning fuel costs will continue to hurt. Interest rates are rising and expected to move up 1 point next Wednesday at the FOMC, Federal Open Market Committee meeting. However, as a long-term holding, it's a good price to add to my position. I only bought a few shares because this could break down through the bottom of the pattern and move lower. In that case, I'll buy more. If fuel costs were stable, the earnings of this beast would improve, according to a Wall Street Journal article, so it's a good buy even though the general market is trending lower. As I read this, I see lots of warning signs, especially with the market trending lower. You want to trade with the trend, not try to push against it. However, I bought at the right time because the stock lifted off the runway at the bottom trend line and climbed. The stock threw back and bottomed at the price of the bottom trend line again before making its way up to cruising altitude. Fast forward to June 2000, price had peaked and had retraced 18% off the high set in early May. Here's my notebook entry for the sale. 27th June 2000. I sold my entire holdings because the stock has pierced the support base of a descending triangle, meaning the triangle had a downward breakout. With seasonal performance moving up in December and peaking in the spring, I missed the high by about $3 share. Ouch. Oil prices are high, raising fuel costs, and interest rates are still high, maybe moving up more. So it looks like the excitement is over, although today the stock is up almost $1. I sold and made 27% on the trade. As good as that sounds, I sold at the day the stock bottomed. After that, it climbed by 89%. Well, spit. This keeps happening if you read about my trades. The day I sell, the stock bottoms and makes a substantial rise. It's one of those catch-22 scenarios. If I hold on, the stock will continue down. If I sell, it'll double in price, thumbing its nose as I watch from the sidelines. Lesson. Assess how far price might drop before selling. The trade might be worth holding on to longer if the downside risk is limited. Hercules Inc. I wrote about Hercules Inc., HPC, as a potential pipe bottom trade, weekly scale, but it's also a broadening bottom on the daily scale. Let me tell you how I traded the broadening bottom. The stock made a nice-looking broadening bottom in May and June 2007. It included a partial decline that correctly predicted an upward breakout. Did I take advantage of the partial decline? No. My notes don't tell why, either. I bought the day after an upward breakout. A better move would have had a buy stop placed at the top of the broadening bottom for a more timely and lower-priced entry. Or I could have bought earlier because of the partial decline, which is more risky. Here's my notebook. Buy reason, broadening bottom and potential pipe bottom. This is also a measured move up pattern, MMU. The MMU began in August 2006 and peaked in March, corrected to the June low, and is now moving up in the second leg. If the measured move were to fulfill its promise, I'd make a bundle because the pattern was huge. The first leg rise was 60%. If the second leg was close to the same length, well, I'd be happy. Additional notes to the trade were skeptical of the measured move working as expected, even after taking half the first leg height and using that as a projection for a target. Just 45% meet the target, so it's likely this will die at the old high, 2140. Half height target came out to be 21.52, suggesting a stall at the old high. This was a swing trade, a short-term one where the potential profit from where I bought wasn't big. I used a volatility-based stop and raised it 4 times along the way to 27 July, when I was stopped out. The market dropped 500 points over second days, and it pulled the stock down far enough to trigger the stop. I sold at 2036 and made just 1% on the trade. That was just 3 trading days after the stock peaked at 2248. So I got close to a perfect exit. The stock appeared to make a 2B pattern. Price exceeded the old high of 2140 by coasting up to 2248 before moving below 15 in a series of roller coaster swings. If I had placed an order to sell my shares at the 2140 target, I'd have done better. Lesson: a better entry was to have a buy stop set at a penny above the top of the chart pattern and not wait for confirmation. The partial decline correctly signaled an upward breakout, so that would help boost confidence that a lower entry price was the correct choice. Lesson: for short-term swing trades, set a limit order to sell at the target price. Sample trade. Sharon likes to think of herself as the brains in the family. While her husband is suffering in foul weather as a carpenter, she is hammering away at her keyboard, a slave to her computer masters. She uses profit from her swing trading to build their emergency fund. Last month, I found a pair of Manolo Blahniks, she sighed. It was a shoe emergency. She glanced at me. My eyebrow ticked up. A shoe emergency? She nodded. Let me show you. We're old friends, so I grabbed her arm. Stop right there. I knew that once she started showing me her collection, I'd be there all day. Sharon is not afraid to short a stock, given good profit potential and an especially weak fundamental or technical situation. It is a stressful life, but making money often is. When I spotted the broadening bottom, she said, shown in figure 8.5, I became interested. The stock reached a high of 37.38 in early November 1991 and had been heading down since. With the stock trading at 14, I wondered how much downside remained, so I drew the 2 trendline boundaries and counted the number of alternating touches. 3 are labeled as numbers in the figure, and points A and B are the remaining touches. Because the stock was near A, heading down, I guessed that it would break out downward on the next cross. I did research to try to prove it, and then I shorted the stock at 13.88. It was a gamble, but one I was comfortable with. I placed a stop at 14.25, just above A. She snapped her fingers. Bingo! 2 days later, the stock plummeted to the other side of the pattern, touching the bottom trend line at point B. Usually my trades aren't that easy. I lowered my stop to 15 cents above C, the nearest minor high, and waited. The stock bounced off the lower trend line instead of busting through as she hoped. She decided to be patient and see what the stock did next. With her stop-loss order in place at the break-even price, she felt protected and comfortable letting the trade ride. A partial rise formed before meeting resistance and heading back down. I believed that when the stock reached the bottom trend line, it would break out downward this time, so I doubled my position. She sighed. I was wrong. It takes a big man to admit that, I said and winked at her. The stock continued down one more day before easing higher. I adjusted my stop-loss order to include the additional shares but kept it at the same price, 13.75s. Then I waited. The stock reached a minor high of 13.13 before heading down again. This time, the decline was strong enough to punch through support at the lower trend line. When the stock dropped below point B toward the end of May, I lowered my stop to 15 cents above B, or 12.15. She looked at the measure rule for the price target. She calculated a target of 9.88 and wondered if the stock would really reach that price. To be safe, she decided to cash out if the stock reached 10.15, or 15 cents above the common support price of 10. A whole number typically shows support and resistance. The stock hit 10.38 on high volume. I thought it might be a one-day reversal. With those chart patterns, it's difficult to be sure if price would reverse or not. I decided to hold on and kept my original target in place. She pointed at the screen. 2 days later, the stock zipped higher and tagged my stop. I made only 9% and moved the profit into our emergency fund. She looked at her watch and gasped. There's a shoe store having a liquidation sale in 20 minutes. They sell Jimmy Choos. I have to go. She raced out of the room. End of Chapter 8. Chapter 9. Broadening formation, right-angled and ascending. Results snapshot. Appearance, a chart pattern with a horizontal or near horizontal bottom and upsloping top. Upward breakouts, reversal or continuation, long-term bullish continuation. Performance rank, 18 out of 39. Break-even failure rate, 15%. Average rise, 43%. Volume trend upward. Throwbacks, 68%. Percentage meeting price target, 67%. Downward breakouts. Reversal or continuation. Short-term bearish reversal. Performance rank, 25 out of 36. Break-even failure rate, 28%. Average drop, 14%. Volume trend upward. Pullbacks, 63%. Percentage meeting price target, 40 cent. Before I began studying this chart pattern, I assumed price would climb away from it, simply because the word ascending was in the title. However, I believe the title refers to how the top of the pattern sees price trending upward, bouncing off a flat base. The pattern is a mid-list performer, based on the rank. Even the break-even failure rates are mid-list, not shown in the above results snapshot. They are within a point of the performance rank. Volume trends upward in the pattern, and I find that unusual when compared to other chart pattern types. Throwbacks and pullbacks happen about twice in every 3 trades, so don't be fooled if the stock returns to the breakout price within a week or so. The percentage meeting the price target at 67% for upward breakouts is much higher than the 40% rate for downward breakouts, but that's typical. A downward breakout is fighting against a rising general market, so you'd expect the stock to drown. Let's take a tour to see what this pattern looks like. Tour. Figure 9.1 puts the formation in perspective. There are 2 right-angled broadening patterns shown in the chart. The left one is somewhat ill-formed, but better performing than the right. Both chart patterns have a base outlined by a horizontal trend line connecting the minor lows. The upsloping trend line skirts the tops of the minor highs. The result is a triangle-appearing pattern with prices that broaden out. Both of these patterns have downward breakouts, but the breakout could have been upward too. In fact, upward breakouts are favored, slightly. Why do right-angled ascending broadening formations form? Consider figure 9.2. The rise began in mid-December 1991 on volume that was higher than anything seen in the stock for almost 2 months. By late February, the stock had reached a new high and was rounding over after meeting selling resistance at 14. The stock returned to 12.25 where it found support. At that point, it paused for about 2 weeks and established the base on which a trader could start to draw a horizontal trend line. The reason for the horizontal trend line is one of perceived value. As the stock approached the $12 level, more investors and institutional holders purchased the stock. The desire to own the stock at what they believed a good value outweighed the reluctance of sellers to part with their shares. The buying demand halted the decline in the stock and eventually sent price skyward again. This happened in mid-April as volume spiked along with price. The buying enthusiasm caused the stock to reach a new high. Momentum was high enough so that the next day, price rose even further before closing lower. With the second peak, a tentative trend line drawn along the tops of the formation sloped upward and gave character to the broadening formation. The stock moved rapidly back down even as volume increased. This decline stopped before it reached the lower trend line, signaling continued buying pressure. Price pushed higher and reached a new high, this one at $15.50 on the 6th of May. The upsloping trendline resistance area repelled any further advance, or so I like to think. The stock simply did not have enough upward momentum to push through the selling pressure at the new level. The next day, volume dried up, but there was enough momentum remaining for another try at the summit. When the attempt failed, the smart money headed back to base camp, and volume receded further. As price collapsed, other investors joined in the retreat, and volume moved up. In less than 2 weeks, price was back at the lower trend line. Another feeble attempt at a new high floundered on unremarkable volume. The stock moved horizontally and stalled out, a partial rise that often spells trouble for bulls. On the 4th of June, price dropped on high volume and returned to the horizontal trend line. The stock paused there for just over a week before moving down and punching through the support level at $12.25. A pullback in bull markets is quite common for ascending broadening formations, so it is no surprise that after a rapid 13% retreat, the stock turned around and pulled back to the base of the pattern. Although not shown in the figure, the stock continued moving upward until it began forming another ascending broadening pattern in late October with a base at $16.50. The ascending broadening formation represents the desire of investors and traders to own the stock at a fixed price, in this case, about 12.25. Their buying enthusiasm pushes price higher until mounting selling pressure causes a halt to the rise and sends the stock tumbling. With each attempt, fewer people are left willing to sell their shares until they receive an even higher price, so a broadening range of prices appears at the top. Eventually, the buying enthusiasm at the base of the pattern collapses and removes the support for the stock. A downward breakout occurs when the stock punches through the support level and declines. It continues moving down until reaching a point where other investors perceive significant value and buy the stock. Upward breakouts see price continue the fight with the bulls overwhelming the bears. Sometimes, the stock will bump up against overhead resistance set up by extending the top trend line from the broadening pattern. It's as if the bulls know there's a turn coming at the extended trend line, so they back off and let selling pressure take the stock down again. Identification guidelines. How do you find an ascending broadening formation? To answer the question, read the selection guidelines outlined in Table 9.1. Microscopes or telescopes are optional. While chewing on the table, look at Figure 9.3, an ascending broadening formation on the weekly scale. Appearance. The overall shape of the formation looks like a megaphone with the bottom of it horizontal bottom support line. The bottom of the pattern follows a horizontal trend line, while an upsloping trend line bounds the top. Look for price to come close to or touch the trend line at least twice in distinct minor lows. Upsloping top trend line. Price should touch the top trend line at least twice in 2 minor highs. Touches. Price should come near to or touch each trend line in minor highs or minor lows. At least 5 touches are needed to qualify the pattern, but be flexible. Don't count it as a touch when price slices through a trend line. That often occurs at the start and breakout from the pattern. If price doesn't touch a trend line at a minor high or minor low, then it doesn't count as a touch. White space. Price should bounce across the pattern from top to bottom frequently, filling the white space with price movement. Price action before breakout. In some ascending broadening formations, price moves sideways for many months while trying to decide on a breakout direction. Eventually, price rises above the formation top or slides through the bottom trend line and stages a breakout. Breakout direction. The breakout favors an upward direction, but it's almost random. A breakout occurs when price closes outside the trendline boundary. Volume. The volume trend is usually upward. Don't discard a chart pattern because volume trends in a direction different from what you expect. Support and resistance. I chose Figure 9.3 because it shows the 2 common areas of support and resistance. These areas follow the trend lines. Along the base of the formation projected into the future, the support area repels the decline over 2 years after the formation ends. The rising trend line tells a similar tale. It repels price 3 times nearly a year later. The implications of this observation are profound. If you own a stock and it is breaking out to new highs, it would be nice to predict how high price may rise. One way to do that is to search for formations such as this one. Many times, extending the trend lines into the future will predict areas of support and resistance. Although the trend line did not predict the absolute high, it did suggest when price would stall. The resistance area turned out to be a good opportunity to sell the stock. Focus on failures. Figure 9.4 shows a failure that's typical for most chart patterns. It's called a 5% failure. Price bounces between the 2 trend lines plenty of times, forming a right-angled and ascending broadening formation, A. Price along the bottom sometimes pierces the horizontal support line, B, and sometimes it falls short. It's close enough, though, to give us enough minor low touches. Depending on how you draw the horizontal line along the bottom of the chart pattern, the breakout happens at C when the stock closes below the line. Price makes a lower low before recovering. It's like dipping your toe into water just after the breakout, finding it too cold for a swim and scurrying back indoors when price rises. Price busts the downward breakout at D when a breakaway gap sends price soaring. Unfortunately, these types of failures happen too often in chart patterns. If you own the stock and it fails to drop more than 5%, then you're in good shape. If you sell a long holding expecting a big decline and it fails to provide one, you might be upset. Chill out. You'll never get out of this life alive. I don't know of many tips to share that limit these types of failures. One tip is to look at the market trend. If the general market is trending higher, that's a plus. If it's moving sideways, I can live with that too. But know the ride might be bumpy. A downward trend spells trouble. Do I really want to swim against the current and risk being run over by a jet skier? I do the same check for stocks in the industry. I count how many are rising over the past 6 months. If I follow a dozen stocks in the industry and 9 of them are rising, then that's good. Too many trending lower could spell a problem for a bullish trade. Finally, after checking the general market and checking the industry health, I'll look at the stock. On the weekly or monthly scale, if the stock has been trending lower for years, then I won't buy it. If it's been making new highs, trending upward in a nice 30 to 45 degree slope, then I feel reassured that the uptrend will continue. That's a momentum play. Ask yourself this: how long will the uptrend continue? Is buying now closer to the start of the trend or the end? Of course, we won't know for sure until much later, but I want to avoid uptrends that end just after I buy. When that happens, it really pisses me off. On a shorter-term scale, look for overhead resistance and underlying support to help gauge where the stock might reverse. Statistics Table 9.2 shows general statistics for this chart pattern. Number of formations. I found 223 patterns in stock data from July 1991 to October 2019 in 703 stocks. However, after slicing and dicing the bear market samples, there were too few to present here. So the following tables only show bull market statistics. Not all stocks covered the entire range, and some no longer trade. Reversal, R, continuation, C, occurrence. Because the inbound price trend can come from any direction, we can't claim this pattern is a bottom or a top. But we can compare the inbound trend with the direction after the breakout. If the two are in the same direction, then the pattern acts as a continuation of the prevailing price trend. If price enters the pattern from the top and exits out the top, that's a reversal. The same can be said if price enters from the bottom and breaks out downward, it's also a reversal. Upward breakouts act as continuations most often, so we know the inbound price trend must have been upward too. Downward breakouts act more often as reversals, suggesting price was trending upward into the pattern. Reversal continuation performance. Reversals for both breakout directions show better performance than continuations. Average rise or decline. The average rise or decline isn't exceptional. As I mentioned, this pattern is a mid-list performer, so don't expect a standing ovation. Standard & Poor's 500 change. The performance of the chart pattern beats the tar out of the index. I can't think of any pattern that failed to beat the general market results. That suggests the measure favors the chart pattern. The chart pattern is performing at its best, from the breakout to the ultimate high or low. But the index, using the same dates, may fall well short of what it's capable of. However, the numbers also show how the general market assists individual stocks to perform. The market rises during upward breakouts and falls during downward ones. Days to ultimate high or low. How long will your trade last? It lasts as long as you do not close out your position. However, I measured the average hold time from the breakout to the ultimate high or low. Pop quiz. If it takes 243 days for price to rise 43% after an upward breakout, how long should it take price to drop 14% after a downward breakout, assuming the same velocity? Answer, 79 days. However, the table shows that it completes the trip in just 51 days. Thus, price drops much faster after a downward breakout than it rises in an uptrend. Often, price drops twice as fast. How many change trend? In a gauge of how well price moves more than 20% from the breakout, this pattern does well. However, it's still a mid-list performer. Have I mentioned that? Table 9.3 shows failure rates for the broadening pattern. For example, I found that 15% of the patterns with upward breakouts failed to see price rise more than 5% after the breakout. Downward breakouts failed almost twice as often. Yuck. Notice as you scan down the list how failure rates increase. Half of all upward breakouts will see price fail to rise 25%. Downward breakouts see half the patterns failing to rise more than 10%. If you want to average 50% on your trades, 72% of them will fail to meet the threshold after an upward breakout. And that's if you trade it often and perfectly. You could make more or less, depending on your skill and the situation. such as just after a bear market ends when even the losers are winning. Sprinkle in some losing trades, and your winners will have to make even more to reach your 50% target. Table 9.4 shows breakout-related statistics. Breakout direction. The breakout direction is almost random, with a slight advantage going to upward breakouts. Yearly position, performance. I sorted the breakout price into the yearly high-low range and mapped performance on top of it. The table shows that breakouts occurring near the yearly low do better than those near the yearly high. It suggests this chart pattern does well with bottom fishing strategies. Buy low, sell high. Avoid momentum trading this pattern. Buy high, sell higher. Throwbacks and pullbacks. Throwbacks and pullbacks occur about 2/3 of the time. Price leaves the pattern for 6 days until it reaches the apex, either rising or falling 6% during the journey, depending on the breakout direction. And the stock returns to the breakout in another 6 days for a 12-day round trip. Notice that performance improves if a throwback or pullback does not occur. After a throwback or pullback completes, we see that price resumes trending upward after an upward breakout, but struggles to drop after a downward breakout. Be careful shorting this pattern after a downward breakout. A pullback may see price drop as far as it's going to. Gaps. Regardless of the breakout direction, a breakout day gap helps performance. That's good news. Why? Because I measured performance from the opening price the day after a gap to the ultimate high or low. Thus, you can buy into the situation after you see a gap and participate in the better performance party. Table 9.5 shows size-related statistics. Height. For both breakout directions, broadening patterns taller than the median height performed better than did their shorter counterparts. To use this finding, measure the height of the pattern from top to bottom and divide by the breakout price. If the result is higher than the median listed in the table for the associated breakout direction, then the pattern is tall. Width. Wide patterns performed better than narrow ones. Take the difference between the end date and start date of the pattern and compare it to the median width in the table. Wide patterns will exceed the median. Height and width combinations. Tall and wide patterns outperform all other combinations. As a general rule for this pattern, avoid tall and narrow patterns with upward breakouts, and avoid short and narrow patterns with downward breakouts. Table 9.6 shows volume-related statistics. Volume trend. I used linear regression to determine the volume trend. I found that it trends upward in almost 2 of every 3 patterns, rising-falling volume. Upward breakouts don't show a big performance difference between volume trending upward or downward. Downward breakouts tend to prefer falling volume for better performance. Breakout day volume. Heavy breakout volume help the pattern perform for both breakout directions. That finding matches conventional lore, where lots of sources claim that a high volume breakout helps. Here's the proof for this chart pattern. However, a survey of the chart pattern says it's only true for upward breakouts, not downward ones. Table 9.7 shows how often price reaches a stop location. I split the pattern into thirds and found how often price, as it moved from the breakout to the ultimate high or low, slid into one of the thirds. For example, I found that price on the way to the ultimate high, upward breakouts, would touch the top of the chart pattern 74% of the time. So a stop placed there would trigger too often to be viable. If you move the stop to the bottom of the pattern, price would reach it only 2% of the time. But if it were to trigger, you might see a big loss. Thus, stop placement, where you have to balance the loss size with how often it'll be triggered, is something traders need to master. Table 9.8 shows the performance over 3 decades. Performance over time. The 2010s, for upward breakouts, showed the worst performance for this chart pattern compared to the other 2 decades. For downward breakouts, the 2000s were worst. I excluded the 2 bear markets during that decade too. Failures over time. The most recent decade, the 2010s, showed substantially higher failure rates than the 1990s. I'm not sure why that is. Table 9.9 shows busted pattern performance. Busted patterns count. A quarter to nearly half of broadening patterns will bust. That means price moved no more than 10% on the 10% away from the breakout before reversing and closing beyond the other side of the pattern. Busted occurrence. I counted how often price single, double, or triple, or more busted a pattern. See the glossary for details. Single busts happen the most. You might think that triple busts would be rare, but they often come in second place, which they do here, but only for downward breakouts. Busted and non-busted performance. I compared the performance of all busted patterns, single busted patterns, and non-busted patterns. I wanted to know if busted patterns performed better than non-busted ones. The table shows that single busted patterns performed better than the other two categories. The problem with a single bust is you don't know ahead of time that a pattern will single bust. Non-busted patterns performed better after downward breakouts compared to all busted patterns. All busted patterns means it's the average for the three busted types: single, double, and three or more. Trading tactics. Table 9.10 lists trading tactics. Measure rule. The measure rule sets a target price, but it makes no guarantee that price will reach it. To use the rule, compute the pattern's height, the difference between the highest high and the horizontal trend line in the formation. For upward breakouts, add the height to the highest high in the pattern. For downward breakouts, subtract the height from the value of the horizontal trend line. The result is the target price. The lower portion of the table shows how often price reaches the target for various heights. For example, if you use the full height, price will reach the target between 40% and 68% of the time, on average, if your patterns are like the ones I tested. For a more conservative target, calculate the height, divide by 2, and then apply the result to the pattern's high or low price. Figure 9.5 makes applying the measure rule clearer. The height of the formation is the difference between the highest high, 34.13, and the bottom trendline price, 29.25, or 4.88. Subtract the result from the bottom trendline price, giving a target price of 24.37. The nearer target in the figure uses half the formation height, or 2.44, to give a price target of 26.81. An upward breakout target would be the height added to the top of the pattern, or 34.13 plus 4.88 equals 39.01. Partial rise or decline. A partial rise or decline can be difficult to trade because price often pauses partway across the chart pattern on its way to the opposite side. This pause looks like a partial rise or decline. Wait before buying to be sure that price is unlikely to continue in the original direction. Try buying when price closes beyond the halfway point between the minor low high and the trend line. For example, if the top trend line is at 20 and price has declined from there to 14 before starting back up in what you suspect is a partial decline, buy when the price closes above 17. That is half the distance between 20 and 14. You might use Fibonacci retracements of 38%, 50%, or 62% as buying locations, but I don't think they'll give you an edge. If price turns at those retracement levels, then consider opening a position, intra-formation trade. If the pattern is tall enough, consider trading between the two trend lines. Buy after price bounces off the lower trend line, and sell after it turns down at the top. If you are lucky, the pattern will break out upward and you can ride the stock even higher. Use trailing stops to protect your profits. When the stock climbs above the nearest minor high, raise your stop to just below the prior minor low. That strategy should give the stock plenty of wiggle room, but adapt it to your market conditions. Stop location. Table 9.7 gives guidance on how often price will reach various parts of the chart pattern on the way to the ultimate high or low. Be sure to adjust the stop location for your tolerance to losing your shirt or blouse. Busted trade. If you are lucky enough to trade a busted pattern that single busts, then that's terrific. You could make a nice chunk of cabbage. Since busts happen between 53% and 64% of the time, the odds are on your side. If the stock double busts, then don't blame me. If the stock triple busts, then the whiplash from bouncing from side to side will make you too dizzy to blame anyone. One advantage to trading a busted pattern is that you know where the pattern ends, and so you know what the breakout price is. With some broadening patterns, it can be difficult to tell where the pattern ends and the breakout price. I suggest you trade only downward busted patterns. Buy when the stock closes above the top of the pattern and hang on for the ride. Experience? Let me tell you about what I found in my trade review. Hughes Supply Inc. Hughes Supply Inc., ASHG, in the fall of 1999 started forming a broadening formation, right-angled and, yes, ascending. Although my notes go back to 1999, I don't have any for this trade, so let me wing it. I bought 4 days after the stock touched the lower pattern trend line and received a fill at 13 even. When I bought, the stock hadn't risen much above the lower trend line, priced at 12.56, so I bought near the bottom of the pattern. Unfortunately, the day I bought the stock peaked and reversed, completing a partial rise when the stock touched the lower trend line. The partial rise correctly predicted a downward breakout, and the stock continued lower. I sold my small position, received a fill at 12.34, and got my hand slapped for a loss of 5%. I was late entering the trade, but I wanted to be sure price was moving higher, away from the bottom trend line when I bought. That sounds like an excuse, but knowing if price will turn at the trend line seemed like a wise choice. I only gave up 44 cents of profit by waiting. I don't know if I had a stop in place to cash me out, and I'm unwilling to dig up my confirmation records to check. However, it's close enough to the 12.56 trend line that yes, I probably did use a stop to exit. So the entry was late but justifiable, and the exit was perfect. I don't have a lesson to share. I traded this well and kept the loss small. XL Group. In September 2009, XL Group XL started forming a right-angled and ascending broadening pattern. It was a long one, lasting until June 2010. The stock made a partial rise, but that failed to see price break out downward. That didn't bother me because I trade from the bullish side. I hid in the bushes and waited for the upward breakout. The breakout happened on the 15th of September 2010, just over a year after the pattern began. I bought 5 days later and received a fill at the market open of 20.99. The breakout price was $20.28, the opening price the day after the breakout, so I bought near the optimum entry price. What was my stop price? None. Why? Because this was a long-term holding. I noted that the downside was 15.66, the bottom start of the broadening pattern. If the stock dropped that far, it would hand me a potential loss of 25%. However, the lowest the stock dropped was 17.69, about a year after I bought. The potential loss was well above the usual 8% or less I like to see, but this wasn't a trade, but an investment. I made allowances. Upside targets were 28, 56, and 69. I also made mention in my trading notebook about this stock breaking out of congestion. It was a small knot, about a week long of sideways price movement. I seemed excited about that for some reason. Indicators? Sure, why not? Wilder RSI was overbought. Commodity Channel Index said sell 5 days ago, the day price broke out upward, which was a bad call. Bollinger Bands were following volatility higher. It suggested waiting for a throwback that didn't happen, and a missing throwback suggests better performance, of course from table 9.4. My computer informed me that volume was not rising consistently over the past 3 weeks and warned of a higher failure rate for the trade because of it. However, it patted me on the back about picking a stock with a rising relative strength against the S&P 500 index. That is, the stock was outperforming the general market. Here's my notebook. Buy reason. Congestion breakout with high long-term potential. Risk 25% versus 100% reward. Could be exposed to hurricane losses if any storms brush the East Coast. Its reinsurance business could get nailed, caused by hurricane losses. Placed a market order to buy at the open since the daily swing is all of 70 cents. Big deal. Bid-ask spread suggests an open higher by 3 cents, but we'll see. Futures at plus 650, so mildly higher open. Nothing really exciting there, except for the potential to double my money. All I had to do was hold on long enough for that to happen. Fast forward to 2018. Along the way, the stock dropped from peak to valley 30%, 25%, and 28% in that order, but the stock always recovered. This was a buy and hold situation, and I was looking to make the big bucks, a doubling of my money. On March 5th, the company announced that it would be taken over by another company. The news upset me. Why? Because I felt they were buying the stock on the cheap. On the weekly chart, this was a cloud bank play, with the base of the cloud at 56 and the top of the cloud at 82. Their offer took me out of the stock at 57.60, below where the stock had once traded at 82. Recall, my upward target was 69, and they were cashing me out just above my middle target, 56. I made 198% on the trade, including dividends. I almost tripled my money, but it took 8 years to do it. In terms of dollar profit, this was my second most profitable trade, but well down the list in percentage terms, so I put a lot of cash behind it. Lesson: good things can happen to people who wait. Lesson: for a buy and hold investment, you have to be able to tolerate large price swings. Sample trade. Palmer sat at his computer desk. His foot hammered the carpet and his fingers drummed the desk. It looked as if he swallowed too much caffeine. I am sure you have met the type. Faced with the situation shown in Figure 9.5, he took swift, decisive, maybe even impulsive action. At point A, where the stock touched the top trend line, he quickly sold it short and received a fill at 33.38. He placed a stop at 34 in case the trade went against him. Then he waited. It did not take long for the stock to cross the broadening top and reach the horizontal trend line. His fingers stopped moving, and he pointed at the screen. I should have placed an order to cover my short at 29.38. That's the value of the bottom trend line. Look what happened. Price bounced off the low. He covered his short the following day, shown as point B, at 30.50. Immediately, he went long and bought the stock at the same price. Palmer placed a stop-loss order just below the horizontal trend line at 29.25, just in case. Then he extended the top trend line. I worried that the stock might not reach it, so I put a target below the old high at A. In less than a week, the stock reached his target and sold at 33.50, point C. Since the stock was still showing an upward bias, he held off trading and waited for the trend to reverse. 3 days later, he sold the stock short again at 33. This time, he put a sell order above the lower trend line at 29.50. The stock moved against me, made me nervous. I wondered what that would look like. He was already twitchy. He couldn't sit still. The stock rose to 34 and oscillated up and down for nearly 3 weeks, never quite reaching his stop-loss point of 34.38. Then the stock plunged and zipped across the chart pattern. It hit his target price at point D, and he covered his short. Sensing a shift in the investment winds, he went long on the stock at the same price but put a stop-loss order below the lower trend line. The following day, I was stopped out at 29.25 and took a small loss. Then what did you do? I asked. He reached for his coffee mug, found it empty, and left the office for a refill. I never did get an answer to my question. End of Chapter 9. Chapter 10, Broadening Formation, Right-Angled, and Descending. Result snapshot. Appearance. The pattern has a horizontal top with lower lows following a downsloping trend line. Upward breakouts. Reversal or continuation. Long-term bullish continuation. Performance rank 19 out of 39. Break-even failure rate 21%. Average rise 43%. Volume trend upward. Throwbacks 64%. Percentage meeting price target 65%. Downward breakouts. Reversal or continuation. Short-term bearish reversal. Performance rank 18 out of 36. Break-even failure rate 23%. Average drop 15%. Volume trend upward. Pullbacks 69%. Percentage meeting price target 51%. The right-angled and descending broadening formation's name is a mouthful, but it describes a pattern with a flat top and price following a down-sloping trend along the bottom. The performance rank places it in the middle of the chart patterns I studied. The pattern favors an upward breakout almost twice as often as a downward one. The above results snapshot shows performance about what you would expect from a mid-list performer. Nothing appears that would blow the roof off the house. Volume trends upward throughout the pattern, and that is unusual. Let's take a scenic tour of the pattern. Tour. What do descending broadening patterns look like, and why do they form? Figure 10.1 shows an example of the chart pattern I caught back in the 1990s. There are the two key ingredients to this broadening pattern. First, price at the top of the pattern reaches the same level, or nearly the same, for several weeks. A trend line drawn atop the pattern's peaks forms a horizontal line. Second, the minor lows touch and follow a downsloping trend line as price drops. Eventually, price breaks out of the pattern by closing either above the top trend line or below the bottom one. In this example, the breakout is downward, which happens in mid-November, the day when the second downsloping line begins, because price closes below the lower trend line there. I require price to close outside the trend line, so that's why the one-day reversal on 3rd of November at the pattern's top doesn't qualify as an upward breakout. On that day, price closed at 19, the low for the day, and below the top trendline value of about 1950. Figure 10.2 shows an example of the broadening pattern with an upward breakout. The top of the pattern is well formed with several minor peaks reaching the same price level. However, two one-day touches compose the lower trendline. A trendline touch is a trendline touch regardless of whether it is composed of one-day spikes or many days of consecutive touches, but they need to be minor lows or minor highs, which these two are. If price cuts through a trendline, such as at the start or end of the pattern, it doesn't count as a trendline touch because it's not at a minor high or low. The figure shows a broadening pattern with an upward breakout, providing a tasty 10% rise in just over 2 weeks. A throwback to the top of the broadening pattern occurs almost 4 weeks after the breakout. I consider throwbacks or pullbacks that happen later than 30 days to be just normal price action and not a throwback or pullback. This one just makes the cut at 27 days. Often, a throwback or pullback will return to the breakout price in an average of 12 days. Why do these chart patterns form? Look at figure 10.3. During 1993, the stock entered the left pattern in early April and moved higher on moderate volume until it reached about 35. There, investors selling the stock matched buyers eager to own the security, and the rise stalled. The stock traveled sideways until 10th of May when it moved below the prior minor low. As the stock approached $31, it entered a support zone set up by the retracement in mid-March. The decline stalled and moved sideways for several days. Due to the support level, many investors believed that the decline was at an end and the stock would move higher. It did. As volume climbed, price gapped up, breakaway gap, and quickly soared back to the old high. The stock ran into selling pressure from institutions and others trying to sell blocks of shares at a fixed price. The available supply of shares halted the advance. Price hung on for a few days, moved a bit lower, and paused before beginning a rapid decline to a new minor low. As volume climbed, the stock declined until it touched the lower trendline, a region of support. Suspecting an oversold stock, investors bought and forced it higher again. When the stock reached the old high, there were fewer shares available for purchase. Investors and institutions who were trying to get $35 a share for their stock sold most of their shares in the preceding months. Soaking up the available supply, the stock gapped upward and closed above the old high. An upward breakout was at hand. The stock moved higher, but soon formed another descending broadening pattern, the right one, in August. This one was compact and tight, but had bearish implications. When the stock tried to reach the top trend line but could not, the partial rise foretold the coming decline. The stock plunged through the lower trending in late September and continued lower. If you look at both chart patterns, their stories are nearly the same. There is a supply of stock available at a fixed price. After exhausting the supply, price either rises above the top trend line or declines below the bottom one. The determination on which way price will go is not clear. Sometimes supply overwhelms buying demand and the stock declines, unable to recover as the stock pierces the lower trend line. At other times, the supply tightens and enthusiastic buyers jump in and push the price higher. Identification guidelines. Are there some guidelines that can assist in identifying descending broadening formations? Yes, and Table 10.1 outlines them. Appearance. The shape of the broadening chart pattern looks like a megaphone with the top held horizontal. Price climbs until it touches the top trend line and then reverses direction. On the pattern's bottom, price declines, making a series of lower lows, following a trend line downward. Horizontal top resistance line. When two, preferably more, minor highs achieve the same or nearly the same price, you can draw a horizontal trend line connecting them, forming the top of the pattern. Downsloping trend line. The same applies to the downsloping trend line. It requires at least 2 distinct touches before drawing the trend line. More touches are better. Touches. I prefer to see at least 5 trend line touches, 3 on one trend line and 2 on the other, with all 5 being minor highs or minor lows, peaks or valleys. Fewer than 5 touches make correct identification more difficult. White space. Figure 10.4 shows an identification problem at AB. There are 2 trendline touches along the top as minor highs and 4 touches as minor lows along the bottom. The pattern looks like a descending broadening pattern. It's not. See that chunk of white space at B. Price doesn't cross the pattern often enough to qualify it as a valid broadening pattern. The inset at C shows that the pattern is better drawn as a downsloping channel. This chart is an example of cutting off a turn and calling it a descending broadening pattern. Do not tell anyone that you found a broadening pattern after you cut off a turn. What you found was a mistake. Breakout direction. A breakout occurs when price closes outside the trendline boundary. Breakouts can occur in either direction, partial rise or decline. A partial rise, as shown in figure 10.3, or a partial decline, not shown, is often a clue to the ultimate breakout direction. When price curls around on a partial rise or decline and returns to the trend line, the stock will usually break out immediately, that is, without crossing the chart pattern again. Volume. Volume tends to rise over the length of the chart pattern, sometimes following the price movement. Support and resistance. The pattern's trend lines, when extended into the future, can sometimes act as areas of support or resistance. Figures 10.1, 10.3, and 10.7 show examples. Sometimes the support or resistance level is active for months or even years. Focus on failures. Since descending broadening formations can break out either up or down, I show both views of failed breakouts. The first one, figure 10.5, is characterized by the telltale partial decline in late November. From there, the stock climbs and eventually pierces the top trend line as predicted. Once price closes above the trend line, you would expect it to throw back to the formation top and resume the upward trend. In this situation, price reverses at 45 and returns to the formation proper, a classic throwback. Unfortunately, instead of rebounding and heading higher like a typical throwback, the stock continues down. It does more work inside the chart pattern before shooting out the other side in a straight line run. Had you bought this stock after the upward breakout, you would have seen the stock decline from a purchase point of about 44.50 to a low of 36.88. A stop-loss order placed at the bottom of the chart pattern would have gotten you out at 39, still a hefty decline. However, if you'd held onto the stock, not recommended by the way, it would have been rewarding. The low occurred on the 8th of April, not shown, and it turned out to be the lowest price reached during the next 2 years. The stock hit its peak in early November 1993 at a price near 60. Figure 10.6 shows a more harrowing tale because it involves a short sale. Investors watching the sharp 2-day decline beginning 14th of October 1994 would be tempted to short the stock the next day. Had they done so, or even waited a few days, they would have opened the trade near the low. From that point on, the stock moved higher, back into the formation, before ultimately soaring out the top. If you were a novice trader and had not placed a stop on your short sale, your loss would have taken you from a low of 24.38 to 53, where it peaked near the end of the study. The figure represents a failure type on, call of 5% failure. That happens when price breaks out in a given direction and moves no more than 5% before crossing the pattern and breaking out in the new direction. This type of failure can turn a small profit into a large loss if stops are not used. Statistics. Table 10.2 shows general statistics for right-angled and descending broadening formations. Number found. I found 1,150 patterns in 668 stocks from August 1991 to October 2019. However, that included bear market patterns, and there were not enough of those to include in the statistics. Not all of the stocks covered the entire period, and some no longer trade. Notice that the pattern favors upward breakouts, judging only by the numbers. Reversal R, continuation C, occurrence. Upward breakouts act as continuation patterns most often, but downward breakouts act as reversals. Recall that a reversal has price leaving the chart pattern in a direction opposite the way it entered. Continuation patterns have price exit in the same direction as the prevailing price trend. Reversal continuation performance. Upward breakouts show better performance from reversal patterns, but downward breakouts favor continuations. Average rise or decline. Shown in the table is the average rise or decline. Nothing spectacular here. Standard & Poor's 500 change. I compared the date of the breakout to the ultimate high or low posted by the chart pattern and compared those to the index. The index shows it didn't perform nearly as well as the broadening pattern over the same holding period. Days to ultimate high or low. Upward breakouts take an average of about 8 months to reach the ultimate high, but downward breakouts end faster, in about 2 months. The yardage traveled is different though, because upward breakouts rise 43% and downward breakouts drop 15%. If you do the math, we find that the downward breakout should have reached bottom in 85 days, not 51. So, price dropped faster than it climbed. How many change trend? I added this measure to help decide which chart patterns lead to outsized gains, a gain or loss of more than 20%. The results shown in the table are mid-list numbers. The upward breakout number is good. More than half the patterns see decent gains, but downward breakouts fall well short of a 20% loss. Just 27% drop that far. Table 10.3 shows various failure rates for the 2 breakout directions. How do you make sense of the table? It is easier to understand by example. I found that 21% of the patterns with upward breakouts failed to see price rise more than 5%. Over half, 51% of the patterns failed to see price rise more than 25% after an upward breakout. You read downward breakouts in a similar manner. Almost a quarter of the patterns, 23%, saw price drop no more than 5%. Half, 59%, didn't see price drop more than 15%. Table 10.4 shows breakout-related statistics. Breakout direction. Price breaks out of the pattern upward almost twice as often as downward. Yearly position, performance. I sorted the breakout price into one of 3 buckets, each a third of the yearly high-low range. Then I checked performance for patterns in those 3 buckets. The table shows that there's not a big performance difference for upward breakouts. Clearly, though, you'll want to avoid trading patterns within a third of the yearly high. Price rises 41%. Downward breakouts also show those near the yearly high underperforming those in the other 2 buckets. It suggests people should avoid momentum trading this chart pattern and focus on bottom fishing for candidates. Throwbacks and pullbacks. Throwbacks and pullbacks occur almost 2/3 of the time, and it takes stocks less than 2 weeks to return to the breakout price. I didn't see any significant performance difference for patterns with and without throwbacks or pullbacks. With other chart patterns, if a throwback or pullback occurs, performance suffers on average. Price resumes the upward move 71% of the time, which is quite good, and the downtrend 55% of the time, which needs improvement, but it's not bad. Gaps. Most of the time, for other chart patterns, breakout day gaps help performance, but we see that behavior in this pattern only after a downward breakout. The rumors you've heard are true. Table 10.5 shows size-related statistics. Height. Tall patterns perform substantially better than short ones. How do you use this result? Compute the pattern's height from the price of the top trend line to the last touch of the lower trend line, the lowest low in the pattern. Divide the difference by the breakout price. If the result is above the median shown in the table, then you have a tall pattern. Below the median means it is a short one. Invest only in tall patterns unless you feel confident of your assessment. Width. Wide patterns outperform narrow ones, but not by an amount worth telling mom about. I used the median length to separate narrow patterns from wide ones. Height and width combinations. The worst performance comes from patterns that are both short and wide. You will want to avoid those. The best performance happens for patterns both tall and wide. The performance differences are large enough that you should pay attention to them when contemplating a trade. Table 10.6 shows volume-related statistics. Volume trend. Volume trends upward most often, but the direction is near random. Rising, falling volume. Broadening patterns with rising volume trend show better performance after the breakout than when volume recedes, as measured from the start to the end of the pattern. Breakout volume. Technical analysts seem to place a lot of emphasis on heavy breakout volume, but as the table shows, the results I found are not statistically significant for heavy or light breakout volume versus performance. Table 10.7 shows how often price reaches a stop location. I split the pattern in half. I sedated it ahead of time and checked how often price returned to the various parts on the journey from the breakout to the ultimate high or low. For example, broadening patterns with upward breakouts saw price return to the top of the pattern 78% of the time. It suggests you don't want to place a stop-loss order there. If you stick the stop order at the bottom of the pattern, it'll avoid being hit 95% of the time, but the resulting loss may be higher than you can tolerate. so do check both the position of the stop and the size of the loss should the stop trigger. A volatility stop may be just what you're looking for. I've hidden some in the glossary. See volatility stop. Table 10.8 shows the performance over 3 decades. Performance over time. For upward breakouts, the 2000s posted stellar gains. Downward breakouts suffered during the same time, and that makes intuitive sense. Failures over time. Failure of price to rise or fall more than 5% after the breakout. After upward breakouts happen most often in the 2010s, and downward breakouts also show a lot of failures in that decade. But the 2000s edged them out. There were 2 bear markets during the 2000s, but I used a coffee filter to remove them from the statistics. Table 10.9 shows statistics for busted patterns. Busted patterns count. I'm always surprised at how many patterns fail to move more than 10% away from the pattern, then reverse and shoot out the other side of the pattern. Here, we have over a quarter, 29% to nearly half, 43% bust the up or down breakout, respectively. Busted occurrence. I sorted the number of busts into 1, 2, or more than 2 busts, triple plus. Single busts happen most often. Notice that triple plus busts place second after a downward breakout. I've seen this in other patterns too. Busted and non-busted performance. Look at the performance after a single busted downward breakout. Broadening patterns see price rise an average of 60%. When I read that, my jaw swung open, my dentures fell out, and I had to pick them up off the carpet. Single busts also outperformed after a busted upward breakout. The 60% number is so startling that if you can find a busted downward breakout, then do consider trading the pattern. Non-busted patterns seem to have the edge, and it's slight on performance if you disregard the single busted patterns and downward breakouts. Trading tactics. Table 10.10 outlines trading tactics for descending broadening formations. Measure rule. Figure 10.7 illustrates the use of the measure rule. Compute the broadening pattern's height by first taking the difference between the highest high, A, 49.50, and the lowest low, B, 43.50. Add the result, 6, to the value of the horizontal trend line to get a target price of 55.50 for an upward breakout. Price reaches this target during mid-March 1996 as the stock climbs on its way to 60. If the stock breaks out downward, the measure rule computation is nearly the same. Subtract the pattern's height from the lowest low, giving a target price of 37.50. Be aware that upward breakouts in bull markets are more likely to reach their targets, 65%, than other combinations. The lower portion of the table shows how often price will reach the target based on various heights. For example, if you slice the height of the pattern in half and use that in the measure rule computation, you'll find price will reach the target 82% of the time if your pattern behaves like the average pattern. Once you've computed a target, change the difference between the target and the current price into a percentage of the current price. Then use Table 10.3 to see how often the stock will fail to exceed the move. Using our example, the target is 6 points away from the top of the pattern, 49.50, which we assume is the current price, or 12% above A, or 106.4950. Table 10.3 shows that 32% will fail to see price rise more than 10%, so the failure rate would be higher for a 12% target. That also means 68% of the trades will see price exceed a 10% rise. That sounds like a reasonable number. Wait for breakout. Because the breakout direction isn't known until price closes outside one of the trendline boundaries, don't try to anticipate the breakout direction. Price may reverse at the trendline, handing you a loss. Stops location. Let's say price breaks out upward. Compute the target price and make a profit and loss assessment of the potential trade. What is the likely downward move compared with the target price? Does the potential profit justify the risk of the trade? For figure 10.7, there is support in the 46 to 47 area. Looking for prior peaks and valleys helps determine support and resistance levels. In March 1995, not shown in the figure, there was an area of congestion bounded by a symmetrical triangle with an apex at about 46. Additional resistance appeared in July and October, as shown. Together, the 46 to 47 area made a good location for a stop-loss order. Let's say the stop price you select is at 45.75, just below the bottom of the support area. If the breakout price is 50.50, which is the close the day after the upward breakout, that gives a potential loss of less than 10%. With a target price of 55.50 or 10% upside, the win-loss ratio is an unexciting 1-to-1. In such a situation, you could either tighten your stop by moving it higher and risk getting taken out by normal price action, or look elsewhere for a more profitable trade. Remember, there is no rule that says you have to place a trade. Let me also say that I'm not a fan of win-loss ratios. If you trade patterns well, the profit should come. Intra-formation trading. If the broadening pattern is tall enough, go long after price rebounds off the lower trend line and hope for an immediate upward breakout. Only try this if you're an experienced swing trader and only after the pattern passes all of the identification guidelines. Partial decline. A partial rise correctly predicts a downward breakout 47% of the time. However, a partial decline correctly predicts an upward breakout 75% of the time. So if you can tell when a partial decline is in place, meaning the broadening pattern is fully formed, see partial decline in the glossary for details. Then consider buying the stock and hoping for an upward breakout. The partial decline might be a pause that happens as price moves to the lower trend line. So if price breaks out downward, then close out the position. Otherwise, hold on to the trade and hope price starts to head back up. Busted trade. With a 60% average rise after a single busted downward breakout, busted patterns might be the way to profit from this chart pattern. See Table 10.9 for details. Experience. I have traded this chart pattern a number of times. Let me tell you about what I found in my trade review. Cisco Systems. Let's start with 3 trades in Cisco Systems. All of them traded the same broadening pattern that formed in June to September 2000. In the first trade, the stock looked to be doing a partial decline. The pattern had a flat top with 3 trendline touches and 3 touches of the lower trendline too, just as you would expect. The pattern looked ripe to break out upward in the high-tech boom of the 2000 market, but the general market turned bearish in March before I bought. I'm not sure I knew that at the time. I bought the stock after it broke out of a small congestion area. It was a small downward trending pennant with an upward breakout buried within the broadening pattern. I expected the stock to break out upward from the broadening pattern. Instead, it touched the top trend line and headed lower. As a swing trade, it would have been good to sell then, but I didn't. I rode the stock lower and sold after a downward breakout. The second trade was also within the same pattern, but I bought as price dropped before breaking out downward. This was a hip shot, a trade I just glance at and make, confident that it'll work. Each time I pen those words in my trading notebook, I know the trade is going to be a loser. That's what I learned over the years, perhaps well after this trade. Hip shots just don't work for me. Now, I take my time to analyze the situation before trading. Anyway, I thought the stock was going to turn, but it didn't. It kept going down. With the third trade, I bought at the lower trend line, expecting an upward bounce. Instead, it closed the day outside the pattern's boundary, breaking out downward from the pattern. The next day, I closed out all 3 trades and took a loss of 15%, 8%, and 4% on them, respectively. My notebook tells what I learned. Lesson: if an upside breakout from partial decline does not appear immediately, sell. Lesson: do not buy more of a stock as it moves downward across the broadening pattern. Wait for it to bounce off the bottom trend line. Otherwise, the breakout could be downward, resulting in multiple losing trades. Lesson: close out the trade when the market tells you you're wrong. National Fuel Gas, NFG, in late 2004 formed a broadening pattern. This pattern broke out upward, and I bought the next day, the same day the stock closed back inside the pattern. I didn't know it at the time. From my notebook, 9th of March 2005, buy reason, busted triple top, upward breakout from RABFD, right-angled broadening formation. The other natural gas companies have stocks that are moving up almost vertically. This one is pausing from recent gains in the rounding turn. Earnings are weak, but the market doesn't seem to mind. I expect the stock to move up as it follows the other natural gas companies higher. Earnings come out in April, and I expect them to be good, sending the stock higher. I think the price is anticipating a strong showing. The stop is a close one, just in case, 7% away. On the 18th of April, I have this curious entry. I removed the stop intraday as I was getting used to my broker. The stock dipped below the stop price, but I didn't have a stop in place, so I wasn't taken out. Stop remains at 27.43. To me, that sounds confusing, as if I removed the stop and put it back in, too afraid that price would take me out. It worked this time, but it's not a habit you want to form. On the 29th of April, I was stopped out of the stock and took a 6% loss. The timing of the sale is odd, though. I sold when the stock was about midway down the height of the broadening pattern. My assessment of the trade says that I sold too early. Indeed, the stock continued lower. 2 days later, the stock busted the upward breakout when it closed below the bottom of the pattern. But that was as far as it dropped. The stock climbed from there, busted the downward breakout, and soared like I thought it would originally. The stock peaked at 63.71 in May 2008, a massive 133% above my sale price. You probably heard me yelling at the time about missing another big gain. I picked the right stock at the right time, but watched from the sidelines as it became an eagle and soared. However, I think I traded this correctly. I bought the day after the breakout, so I got in quick at a good price and sold when it was clear the stock was dropping. Waiting for it to turn at the bottom of the pattern, in this case, was not a mistake because it did break out downward. The stock just decided to turn back up from then on. Lesson: if a stock doesn't perform as expected, get out. Lesson: don't lower or remove a stop unless you have a good reason for doing so. Being afraid price might trigger the stop is exactly the wrong reason for removing it. Southwest Airlines. Southwest Airlines in mid-2004 showed a similar situation. I identified a broadening pattern in the spring and bought after the throwback completed. In other words, I was late buying into the stock. Had I placed a buy stop a penny above the top horizontal line, it would have filled at 15.31 the day before the actual breakout. Instead, I bought in at 15.81, but that isn't too far off the optimal entry price. From my trading notebook: mood, will trade work, bought too soon, cautious. Other airlines are moving lower, so I don't really trust this one. Long term, I think the price is a good one. Short term, who knows? Buy reason: throwback from RABFD completed and oil prices are trending down. Since most of the fuel is hedged, the price won't make much difference. If it can push through the HCR horizontal consolidation region, flag in Deck 2003, then this has a chance of moving up. The stock formed a second broadening pattern, and that one broke out upward too, making a sharp rise upward, 5% rise in one day. The move looked like an earnings surprise where price shoots up and then retraces the move over the following week to 10 days. That's what happened here, except earnings came out a few weeks later. My notes say I should have sold the day of the 5% spike and locked in a profit. Instead, I took a 3% loss when the stock returned to the price of the top of the broadening pattern, where I sold. Lesson: when the market gives you a gift, the 5% rise, find the reason for the move and consider selling. I don't know if that's good advice or not. In earnings surprises, it can pay to hold on for months because the announcement generates excitement, and that excitement pushes the stock up, after the retrace that is. In this case, I don't know what caused the 5% rise. Conway Inc., CNF, now CNW, formed a broadening pattern starting in November 2003 and lasting until April 2004. Here's my notebook entry: 21st April 2004. I bought at market, filled at 37.13, 11:06 a.m. This is an upside breakout from a right-angled broadening formation descending. Measure rule says 41.14 is the target. Call it 41. Downside is just below prior minor low, 34.33 for 8% loss. The truckers are doing well right now, despite wishy-washy market and high fuel costs. The company also announced earnings that apparently were better than expected. I bought the day after the upward breakout. Over the next 2 weeks, the stock threw back, but I survived by holding on. My fingers hurt. The stock started climbing in a measured move up type pattern: rise, retrace, rise. I raised the stop not once, nor twice, but 7 times along the way to the sale. On the 12th of July, the stop-loss order took me out of the trade. From my notebook: mood, sell too soon? Good. The stop took me out, and this morning, the stock is trading even lower. Earnings are due in 5 days, so maybe the stock is signaling weak results. Time to move on as it pierced the trend line on the sell day. What trend line am I referring to? The only idea I have is to draw one connecting the throwback low along the bottoms as price climbed. The stock broke out of a 10-day congestion region and pierced the upsloping trend line at the same time. That's when I sold. I made 8% on the trade, but sold too soon. Yes, the stock moved sideways for almost 3 months, but eventually made its way to 61.87 or 54% higher than where I sold. For a swing trade, it wasn't supposed to be. This was a good execution. I bought the day after the breakout and sold before weakness took the stock lower and threw it sideways to down for months. For a longer-term position trade, which was intended, I missed the big gain. Again, lesson. When position trading, allow for more volatility to capture longer-term gains. Sample trade. Ralph is a pattern trader with a measure of experience milking chart patterns for all they are worth. When he noticed what he thought was either a descending broadening wedge or a right-angled descending broadening formation, he bought the stock. His order, placed at point C in figure 10.7, 46.38, was just after the stock bounced off the lower trend line. He monitored the stock closely and watched it move up the very next day, then ease lower. After a few days, I saw the symmetrical triangle form and got worried. Those things are unpredictable. When the stock moved below the lower triangle trend line, Ralph sold the stock and closed out his trade at 46.50. He cleared the image on the screen and looked at a chart without any lines or indicators. Just price. Ralph smiled. I made the right decision to sell because a partial rise, such as where the triangle formed, can predict an immediate downward breakout. Sure enough, the following day price dropped even further, tagging the broadening formation trend line again. Then the blasted thing bounced on me. Caught me by surprise. I wasn't in the stock then, but I like to think I made the right decision to sell. The thing went all the way back up to A, right where I hoped it would go during my trade. But no, Ralph took a small loss after factoring in commissions. I sold at the right time. The stock broke out downward from the triangle and could have continued a lot lower. In hindsight, though, I could have waited to see if the stock found support at the lower trend line. It was close enough that I could have tolerated the potential loss. In this case, all I had to do was wait no more than 3 days before price started climbing to A. End of Chapter 10.